that there's lots of times that they don't work out well. And in fact, what I call the most important rule in technical analysis is actually a failure rule. It's basically that when a chart pattern fails, that is a signal in itself, and it's a more important signal than when you get a chart pattern that seems to be confirmed. So I always spent a lot of time trying to make sure that people understood that don't just take anything because this example works. Don't jump to any conclusions. You always have to test everything on a broad portfolio over a broad number of years, but almost all books, almost all articles don't do that. They just take things that work and they allow the reader to jump to the conclusion that this thing is really the best thing invented, and when it's really not.
Yeah, I'm really glad you sort of went into that in so much detail, Jack. I think that's a really important point. But let's move this along a little bit. So I'm keen to hear a bit more about what you're working on these days. I know you're keeping busy with FundSeeder, as well as been working on some indicators with TradeShark. But let's start with FundSeeder. So give us an overview of what this is all about and how this platform is helping traders to improve.
Okay, so FundSeeder, first of all, to give credit where credit is due, I'd like to say it was my idea. It wasn't my idea. It was an idea of a colleague, Manuel Bellari, who I work with on a different project. At the time he was with ADM Investor Services, and I was actually, our relationship started when I was still with Fortune Asset Management, which was a hedge fund advisory firm that got acquired. But we continued to work together, and in terms of constructing portfolios, and I was an advisor for that project. And these are portfolios of hedge funds. In any case, one day Emmanuel said to me, we were at a conference, and he said, I've had this idea, tell me what you think of it. And he was the FundSeeder concept. So his concept was, and what the FundSeeder concept is to create a website, a web meeting place that would be the intermediary between undiscovered traders, primarily undiscovered, it doesn't have to be undiscovered trader, but traders, particularly undiscovered traders, and investors looking for trading talent. And they could meet at the website, you could also think of fundseeder.com as a search engine for trading talent. So that's the basic idea, and very critically part of that idea is that you just don't try to get traders to register with your site and put them on and get their numbers and post them. A very, very essential part of this concept is that you don't get the numbers from the traders, you get the numbers directly from the broker. So traders would register on the website and link their accounts to the website. So therefore, the numbers that would be collected on the website would be numbers coming directly from the brokers. So it gives it much greater validity and sort of implicit verification in that process, vis-a-vis most sites which will just take numbers that are provided. So that was also an essential element. And to get traders to the website, the key is that you're going to provide this verified track record, and that will make it easier, much easier for traders who would have not a prayer in the world of attracting money, let alone institutional money, of being able to do so if they are trading talent. We in fact have, unbelievably, with the site still pretty early on, we're still in the early stages, but even at this point, we have literally traders registered from over 100 countries. I mean, I found that astounding. I think it's astounding enough there's traders in 100 countries, but the fact that we've already have that many different countries represented, and this is still very, very early on. We've only just recently expanded the site to go beyond the initial couple of brokers we were able to directly link with a few brokers, and now we can link with virtually all major brokers. But that just happened. So this was even before that point. So you take traders in some developing countries, let's say, or some Eastern European countries, take a trader I don't know, anywhere. It could be in the Ukraine or whatever, who has a math degree and develops a trading system that's really good. Is he going to have any chance of raising any money? Institutional money? Not a chance in the world. But if he can get a small stake together and trade it and get a track record that's coming from the broker, he can build up a track record that can then be used to attract attention. So that's the basic concept. Now, so far we've only done the trader side of it. We had originally planned to have a trader and an investor side together as one website. And for regulatory reasons, we decided to keep those separate. That we would right now we're just in the process of building the trader side and getting attracting as many hopefully talented traders as we can worldwide to the site and building the track records and ultimately hoping to be the site people go to or that can be used to find trading talent. And at this point, there is no investor side because that's where our focus is. We will later this year construct the investor side of that as a separate site, which we will then populate with. We will use traders from the trader side as a source for the investor side. And the investor side will be through a registered company and which will have all the appropriate regulatory compliance met and so forth. So we're just taking care to do it that way. But as far as traders are concerned, while this site is not directly accessible by investors, there will be a one company that holds both sites, and if there's trading talent that shows up on the fundseeder.com, we're going to be using that site to find trading talent and hopefully in the future lead some of that trading talent or connect some of that trading talent with investors, primarily basically, or maybe only institutional type investors looking to allocate money to undiscovered traders. Oh, and I should add one thing. The site right now, there's a current platform that allows traders to do stuff that they really can't do on most normal platforms, like get an equity curve and do analysis on an equity curve. We are, however, that was basically the first platform we're using. We currently have under development we have a technology team doing a whole completely new platform that will have literally 20 different trading tools, including all sorts of graphics and analytics that one can perform on one's trading record, both the equity and trades themselves. And will allow stuff like besides just equity charts or even underwater charts or other. Will allow charts, say rolling charts of let's say rolling return charts or rolling Sharpe ratio chart or any metric you want to choose. We'll have tools that allow traders to create use technical tools, let's say like a crossover moving average to apply to their equity curve, so they can signal when their equity curve is starting to trend down. So they could use that as a cautionary signal to maybe take a second look at their trading, or maybe cut back trading or stop trading or whatever. So we'll have Monte Carlo simulations on and on and on. Now that new, much more comprehensive and much better graphics website will come on stream probably sometime in the fall. If people go to fundseeder.com and register, then anytime we do anything new, like we just did when we expanded the accessibility through almost all major brokers, which was a new thing. We did that just days ago. We put out a newsletter. So if you're registered and we have the new platform, you'll be notified of that. And traders now, as I say, almost no matter who their brokers are, can probably link to the site.
Okay, excellent. I mean, that sounds like a really good platform. Definitely can see how it's going to help a lot of traders out. One thing I've got to ask is, have you been surprised and maybe pleasantly shocked with some of the results and talent that have been produced by users of the site?
Well, it's too new to answer that question because, unfortunately, track records materialize in real time, and we're tracking from when. Now, in some cases, it depends. with some brokers like Interactive Brokers, I think when they sign up from there, the backtracker gets imported, and we do have some good traders that are evident through that. But it depends on the broker. And for a lot of brokers, there's no past record that's imported, so it just gets built in real time from the point of the registration or the account linking. In some cases, a small amount of data, but for the most part, for most traders, we really have to wait for the track records to develop. Now, I wouldn't be surprised. One of the things I do anticipate is that we will find some really exceptional traders that are unknown to the world through this process by linking out on a global fashion. Like I say, once you go out, you're literally getting people from 100 plus countries. You're going to be looking at people that no one else has looked at before. And that combined with the idea that you only need a tiny, tiny fraction of all traders to be really good to have a substantial number of excellent traders. So I don't know how many traders there are. There's certainly many millions, maybe tens of millions across the world. Who knows? But you only need a tiny fraction of those, a fraction of 1% to be good, to really have a large number of good traders. So it doesn't have to be a large percentage. So I fully expect that we will have some really good traders come out of this process. And in fact, one of the things people will see if you go on the website is this thing called Market Wizard Search. What the Market Wizard Search is there's going to be some future book called Undiscovered Market Wizards, and that those undiscovered market wizards will come from traders we discover through this website. And a book ain't going to happen this year or next year. It's going to take a few years of kind of having this thing run, and but at some future point, when we feel we have, or I feel I have enough traders identified through the site who seem to have been able to perform for enough time with enough consistency, then there'll be this book called Undiscovered Market Wizards. So I'm expecting that to happen, and I would be surprised if we don't find enough traders to fill a book.
Very cool. I mean, that's definitely something to look forward to. So all the traders in that book you plan on sort of sourcing from fund seed?
Yeah, that's the plan. That's the plan. I guess I shouldn't. I mean, if I find some unknown trader in a different way, I guess I wouldn't rule out that they would go. But my primary source for this book is going to be indeed the website. That's the plan, and. If I'm wrong, there would be a book, but I really have trouble believing that I won't find at least a volume of. I'm sure I'll find more than that. I think we will have more than enough people to be able to choose, a book's worth of what I call undiscovered market wizards.
Yeah, no doubt. I'm sure you will. I'm sure you'll definitely find some. So, let's just change topics and speak a little bit about on the Trade Shark front. I'm keen to hear about the indicators you've been working on there. So, tell us a little bit about maybe what Trade Shark is and the indicators you've been working on.
So Trade Shark is a chart software company, and not just because I did a project with them, but their chart software is really very good. You can tailor your charts very precisely the way you want them. Easy, it's intuitive. It's a very, very nice chart package and lots of indicators, and including quite a number of proprietary indicators. But that's a matter of people find what works for them and so forth. So I never endorse other indicators or anything else, because even my own I wouldn't say anything I don't make any guarantees about it. I mean, I can tell you what they are and all that. But so they had asked me to do this project. They wanted me to create some indicators, and they had two other people that had created, Larry Williams and I think Ralph Vince had created some proprietary indicators for them. And they asked me if I would be willing to do that. And I said, tell you the truth, I'm just not an indicator person. I actually don't use indicators myself, have not used them. And while I've worked on systems, trading systems, and I've done a fair amount of work on trading systems, I've really never done indicators. But I said, let me think about it. And I thought about it. What I actually ended up doing was I realized that the system work that I had done could actually be transformed into indicators. And So there was a project I had done way back. Well, I guess it was at least over 25 years ago. And I had done it with my partner at the time, Louis Lukac, who was a real computer whiz, and he's always programmed everything I've done actually since the time we met. He's always been the fellow who's done the all the footwork, all the programming, and all the hard work, And so anyway, we had developed when I was at Prudential, I had developed this in-house trading system, and we had come up with certain systems that we were putting out signals on and all of that. So the idea was to use those systems with different parameters, and those systems included both trend and some counter trend approaches. And the idea was to create indicators that were composites of those, using different inputs, combining different systems, so to speak, into a single indicator. So there's one indicator that's called the trend weight. Well, the trend weight's really a composite of different systems, and there's also an overbought, oversold indicator, which is a composite of different counter trend systems. And there's one that's directional weight, which basically adds the two together. So if the market's trending, and the trend's sort of reaches a maximum reading and stays there for a while, or is very high readings, eventually the counter trend starts to build up, and at some point if the directional weight which combines the two can come back to zero or even reverse direction while the trend is still looks like it's running. So that's a third tool, and then there's something called a dual trend, which basically takes a trend weight and combines it with one of TradeShark's own indicators, which is a much shorter term indicator. So my stuff tends to be more. The indicators are really, and I did a set of videos. The videos are available for free at tradeshark.com. You could find them. You could find the indicators. There's not the indicators, the videos. So the videos are for free, and you can look at them. So this is all explained. So there's one on each approach. And there's one called the dual trend, where the dual trend takes the trend weight, which is intended to capture long-term trends in the market. That's what it does really well. It's good at staying with trends and all that. It has defects of any trend approach, which if you get a very choppy market, it is going to lose money. But on balance, over the years, the reason I took something for 25 years old, so we could test it for the past 25 years, I wanted to make sure that in the interim it was something that had a significant edge in working versus so that I could make at least confidently say that based upon 25 years plus empirical evidence, there's a much better chance going with it than against it. So it was important to be able to test something like that blind. That's why I wanted to use something that was developed a long time ago. In any case, that is combined with TradeShark's another TradeShark indicator, which is much shorter term, and that's called the dual trend. And I kind of like that because they're so different, and that the dual trend will change much more quickly, but it also won't be anywhere near as good in riding trends. And combining the two has nice properties. So that's a fourth approach. So there are these approaches. They're explained by the videos. They're more inclined towards a systematic approach to markets. And I also arranged them. One of the key things I did was to have them each have inputs that needed to be defined. So there's not just one fixed way to use it. You have to define a threshold conditions for each of these indicators. And there's also, you can choose something like an early exit, an early reversal, which are explained. And by doing that, you can turn these indicators into your own sort of approach, which is very important because I don't want to go counter to my own advice. I always tell people, don't just get a trading system and follow it. Don't buy somebody else's trading system and follow it, because the odds are you're not going to last, because as soon as it has a bad period, and every system has a bad period, you're going to abandon it because it's not yours. So I made these so that they can be combined, they can be used together, they can be used, you can vary each one. And so two different users can develop completely different signals off of the same indicators. And that was critical because one of the essential points is that users need to make these, to choose the parameters that go with these approaches so that they fit the way they are comfortable trading the markets. And when you do anything, one thing that's good about TradeShark is that you can actually see, like you could do stuff which I do in the videos, is like anytime there's a buy signal, it's shaded green. Anytime there's a sell signal, it's shaded red. And it's neutral, it's, let's say, yellow as an example. Well, you can superimpose that on the price chart as a lightly shaded backgrounds, and you can pull in the data, let's say, the last 10 years, and then you can walk through 10 years of data using this particular approach and see exactly how the market did. It's not fitting it to what it did. You could see, had you done this 10 years ago, and theoretically you could have done this 10 years ago, again, because it's based upon stuff that was developed 25 years ago, how it would have performed in a real sense. And so users can get a real sense of what one particular adaptation of these indicators would actually work, and can experiment and see very visually where the buys and sells are coming in.
Yeah, yeah, good one. Well, I'll put a link to those videos in the show notes for this interview. And if you want to access the show notes, just go to chatwithtraders.com/27, and the links will be underneath the interview. But I mean, Jack, we should probably start to wrap things up because we've been going on for a little while now. But before we do this, one last question, and I'm sure you have a ton of great quotes and one-liners which you've picked up over the years, and it wouldn't be right to ask you what's your favorite, but is there just one or two quotes that you would like to leave us with before we wrap things up?
Okay, that's an interesting question. Okay, I'll give you two quotes. I'll give you one quote from one of the people I interviewed, and I'll give you one quote that's my own. Interview from the people I interviewed, and this is the quote. This is what I tell people. If someone said to me, Jack, we want you to give your best trading advice. We only got there's one kind of condition or constraint here. You can only use 10 words. So if I can only give advice in 10 words, right? And this is the quote I would use. And it's a quote from Bruce Kovner. And the quote is, know where you're getting out before you get in. The quote that I would use, and I guess I should just explain why that's so important. Well, for one thing, it sort of guarantees risk management. And for the other thing is, it is much more subtle. And that subtlety is, you're making a decision of where to get out of a trade before you get in, means that you can make that decision with the benefit of complete objectivity. Anybody who's been a trader will know that once you're in a position, you lose objectivity. So most people, almost everyone, will get into a position and worry about getting out at some later point. But once they're in a position, your thinking gets clouded. If you can decide that ahead of time, as Bruce Kovner suggests, then you're thinking from a much more objective and, I believe, a potentially successful frame of reference. As far as my quoting myself, there's a line I have, I'm sort of paraphrasing it, and it goes to this idea of finding your own approach to market. And the line is, there's a million ways to make money in the markets. Unfortunately, they're all very difficult to find, but there are a million ways. And the point is, don't worry about finding the one way. There are lots of different ways, but they're hard to find, but there are lots of ways. And only a very, very small number of types of ways are going to be right for you.
Yeah, both extremely great quotes, Jack. Thanks so much for sharing those, and thank you so much for coming on the show.
I appreciate that. You really did your homework on those questions, and you did a really extremely. I've done quite a number of interviews over the years, and you did a really good job on touching on a lot of different subjects, and clearly doing your homework. I appreciate that from your side. And I think the one drawback is that I think this podcast could end up so long that maybe you have to break it into two parts. I don't know, but whatever.
Yeah, no, that's great. But before and thank you very much for that. I appreciate your feedback there. Before you go, do you want to share with listeners where they can go to find out more about you and stay in touch with what you're up to?
Right. Okay. So, again, the main site, the company that I'm involved in is fundseeder.com. I also have Jack Schwager, my name.com, which I no longer update, but there's stuff up there. There's stuff up there. Interviews and articles and links to books and stuff like that. But and the other site is funseater.com. So those are the two sites I would direct people to.
Okay, good one. Well, I'll put links to everything we've mentioned during the interview, so your books. You're also on Twitter, aren't you? So I'll put your Twitter handle in the show notes. Yep, cool. And links to Funseater, TradeShark, and everything that's been mentioned. Just go to chatwithtraders.com/27 and you'll find everything there in the show notes. Again, Jack, thanks a lot for doing this. Take care and let's talk soon.
Oh, it was fun doing. Okay, have a good one, Aaron.
Thanks, Jack.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve risks and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up everybody? Welcome back to a brand new episode of the Chat with Traders podcast. This is episode number 28. And before we go any further, let me just say a huge thank you to everybody who listened, tweeted, shared last week's interview with Jack Schwager. I was thrilled to have him on the show, and it sounds like you guys all really enjoyed it, so thanks so much for listening. Now, let me tell you a little bit about this week's guest. And he originally was attracted by the fact that traders can make money in both rising and falling markets. So this week's guest, Andrew Faldy, left a career in commercial real estate when the GFC hit in 2008 to focus his attention on becoming a trader. A few years on, Andrew has carved a profitable niche for himself, trading options and designing systems, both topics which are covered in depth during this interview. But some of the highlights from this discussion would have to be the way in which Andrew avoids trying to predict the market and instead thinks of trades as a series of if-then scenarios. Also, the purpose of why the options market even exists is really interesting, as well as the important factors one should consider when designing a system. I also like how Andrew applies a blend of systematic and discretionary aspects to his own trading, which we go into during this interview also. And if you have any questions, so If there's something you're challenged with or something you want to know more about, then take this opportunity to ask Andrew a question. Whether it's in regards to trading options, designing systems, or just trading in general, Andrew's your man. So leave a question for him in the comments at chatwithtraders.com/28. Just scroll to the bottom of the page and leave a comment, and Andrew will get back to you. All right, guys, I'm your host, Aaron Fifield. This is Chat with Traders, and here is this week's guest, Andrew Fordy. Andrew, welcome to the podcast, man. How's it going?
Doing great. Thanks for having me on.
No, thanks a lot for coming on the show. I mean, I really appreciate it. And there's a few things I'd like to cover with you today. So, of course, we'll begin with how you got into the world of trading and what your early experiences were like. But from there, we'll get into some discussion about options and sort of systematic trading. And seeing as you're very clued up on options, where as I'm almost a complete novice in this area when it comes to options, but I mean, listeners will probably recall me saying that from previous episodes, but feel free to add to your answers with anything that may be valuable, even if I don't necessarily prompt you with my questions. So,
okay, sure.
Yeah,
I can do
like
that.
a plan?
Yeah, sounds great.
All right, cool. So let's start from the start. And if you don't mind, share with us, what were you doing before you got into trading? And then what actually sparked your interest in the markets?
Well, before I became a trader, I was a full-time commercial real estate broker in Florida. And when I was kind of developing my career there, and I was working on teams, and through unfortunate timing, my career was just starting to grow when the Great Recession hit. And Florida specifically was kind of the epicenter for the real estate crisis, where a lot of the United States real estate values dropped 10, 15, 20%. And in the area where I live, things dropped by closer to 50 and 60%. And so our local market went to more of a a depression, whereas the rest of the country went into a recession. And at that time, so it was challenging, and it looked like it was going to be very difficult for several years. And one of my mentors that I've known ever since I was a teenager, he also had a lot of commercial real estate holdings, and we were involved in the business together, and we were discussing it, and he had some investments with a hedge fund that was trading options, and they were doing very well. And so we said, well, this is great. The market's going down, and they're profitable. It was totally counterintuitive, and we did not understand how that was working. How are these guys trading options, which is, part of the stock market? They're trading S&P 500 options, and, the market's crashing, and everything's bad, and the economy's going in the toilet, and these guys are making money, and they were making a lot of money. And we're like, we have to figure out what's going on. We have to know what's happening. And so we both kind of parallel went into this education process of kind of self-teaching and exploring what was going on. And so that was back in 2007, 2008. And we're going through that process and a lot of studying. And one thing led to another that I just decided that I didn't want to tie myself to a local economy. I didn't want to tie myself to one industry and one sector, and that by trading the markets, I was going to have the ability to be in any market that I wanted to be in and anywhere in the world, and I could do it from anywhere in the world, and that I could actually profit like these guys, whether the market went up or down. And I said, that's the path I need. I need to be on that path. I need to have that opportunity where I'm not dependent on a strong economy. I'm not dependent on economic growth for how I'm going to do each year. So that's kind of what spurred everything, and how I became attracted to the trading world. And then one thing led to another, and just through my natural instinct to network and work with traders and work with business contacts and really just get out there and not just live in a bubble. I got to know a lot of great people and got connected with SMB Capital in New York, and really was able to expand and get my trading up and running and go full time.
Okay.
That's kind of the background.
Right. Yeah, that's a really good answer. So let's get into that sort of education process, which you briefly touched on there. What was that like? Like, what was the process you went through, and what was the education that you were sort of absorbing right at the very beginning there?
Right. Everybody starts probably in a similar place where they're gonna absorb all the free information that's available. So, there was lots of hours on YouTube and lots of time on blogs and social media and trying to find videos. And then you go buy the stack of books from Amazon and you get them and you start reading all of them. And, that kind of orients you to what's going on in the lingo. But it really, the unfortunate part of that is it can lead you down a challenging path, because you may start to learn the language of trading. You understand the concepts of what the different tools are and what the different instruments are. And maybe they talk about strategy, but they don't tell you what to do. They don't guide you, either from liability, or they just don't know what they're doing and they just know how to explain the market. They might just be a financial publisher and not really a trader. And so you don't really get the tool. You understand about it, but you don't understand what to do or how to do it. So it was kind of like a struggle. There's a lot of excitement about the possibilities, and but really just not having any guidance made it kind of challenging. And then little by little, I realized, and then the other traders I work with realize this even quicker than me, is you have to, if you really want the best information, best education, and you want to accelerate your knowledge, accelerate the growth of understanding and your personal growth, you got to hire people. You have to hire the experts to teach you. And so we went down that path, and many tens of thousands of dollars later of educating ourselves, that's really what it took. It really took that for us and some people say, and I've heard this by educators that I've worked with and respect very much because I know they're excellent traders and they also teach, is when they tell somebody about trading and they give them a strategy and they tell them what not to do and give them guidance on what they should be focusing on. If they give that away for free, the person never follows through. And they could charge $1,000 for the same conversation, and the person that pays $1,000 is going to pay attention, they're going to take notes, and they're going to hold themselves accountable for a period of time because they put money on the line that they're going to take that knowledge and apply it. So that's what happened for us. We spent lots of money, different service providers, and the best education I've ever received was through SMB training, and that's why I stuck with them and really started to develop a relationship there so that I could take that information and kind of help share it with other people and help other people learn the way I did. Hopefully the right way, not spending too much time, trying to consume free information and think that's going to help them grow their trading business.
Yeah, sure. I mean, I have actually heard that in the past, that when you do pay for something, you do tend to, in most cases, pay more attention to it and actually benefit from it more so. I mean, that's probably like a, marketer's favorite phrase as well, but it does actually, it genuinely holds weight in most cases. So that's a good point that you brought up. And you also spoke about, in your answer there, about he spent tens of thousands of dollars on education. I mean, surely no one actually wants to pay that much. In hindsight, how could you have maybe not spent so much on education? Like, how could you have? I'd
say, I could probably go through and pick out 20,000 of that we could have skipped, in hindsight. But you don't know which thousands of dollars and which courses and what instructors and what online programs. In hindsight, we know that some of those, it probably gave us more of the tools and taught us about the market in a way. And by having the cost involved, we really had to absorb it. And that helped us probably at some level. But the parts that mattered, it's probably $3,000 or $4,000 worth of education after knowing the basics that really gave the tools that hard and fast, here's your training wheels. Just follow these guidelines, do exactly these steps from day to day. And, most people's personality, most traders' personalities aren't going to be able to live, following a very specific set of rules. from day to day, but by starting that way, by doing it that way and letting a system work, you can realize that it's not about your intuition in the market. It really is about strategy. It's really about using things, doing things that make sense, doing things that work. And it's not about your ability to predict. Once you get past that and you stop thinking that the only way you're going to deserve a profit is by predicting, then that kind of frees you of that responsibility, and you know that you can just apply things that work in the right circumstances. So that's probably, tens of thousands is not I'm not going to say that's what it takes. That's not true at all. But I think it does take a few $1,000s of education to at least accelerate your process. Take somebody else's 10 years of experience and pain of developing how it works and let them teach you in a few hours. Let them show you or let them mentor you over a couple of months and just shortcut all of the trial and error and get to what works. Generate profits from it and then go from there and start developing your own ideas. But just trial and error alone that's how it becomes, you're going to be going against the odds for your success. Because most people aren't willing to pay for somebody to help them. Most people think you have to predict what the market's going to do to have a profit, and that's just simply not the case.
Sure. Okay. So even for you in the sort of the first few years of your journey, if you had to put it down to maybe one or two things, what would you say were the biggest challenges that you had to push through when you were coming up? So challenges that essentially impacted your P&L in a negative way.
Right. So thinking I have to predict is where it stems from. And then the second part of that is when you're wrong, then you have no plan. Because you say, well, I made the prediction. And I really feel in looking back at the early struggles, I really feel like I thought that if I didn't predict it right, I didn't deserve to change my mind and then, stop losing money. Like I had to take that pain from being wrong, and I had to wait until the market agreed with me to get out of the position. And that was probably the worst and most stressful times, where I went through a few different mouses where they'd get smashed and I have to go get another one and all that stuff. But now knowing that it has nothing to do with predicting, and I don't have to feel like I earned a profit by guessing what was going to happen correctly, that now it's more about adapting to what's going on and knowing the two different probabilities in every market, which is the trend and the range. If the trend is identified, then you can expect continuation in that trend. However, you have to respect the range as well. So if you're a little bit overbought in a bullish trend, you can't just say I have to be bullish because it's bullish. You can either be flat or a little bit less long or maybe even a tiny bit short if you want. But really getting past thinking, well, we're overbought, the market has to go down, and that's the only way I'm going to make a profit this week. That there's a lot more ways to do that. So I want to make sure I answer the question fully. Early struggles, is that kind of what we're getting at?
Absolutely, yeah.
Challenges. So thinking I had to predict, not being willing to admit when I was wrong and get in the right direction again. Poor strategies, the wrong strategies on the wrong instruments. That's a big one. So frequently managed income trading styles on low-priced ETFs, that's just a recipe for disaster. So, if you have an iron condor or a butterfly management strategy and you trade that on an ETF and you hear people talk about fixing and adjusting and managing their profiles, you say, okay, I get it. I'm going to use ETFs and I'm going to use an income strategy. I'm going to manage it frequently to make sure I keep it under control and wait till I trap the market. Well, you got two things right and one thing wrong. And the one thing wrong is you're using it on the wrong instrument, which means your commissions are going to be 1,000% more, give or take, whatever the exact number is. But you're spending 10 times as much on commissions for frequent management, which means you're running uphill with the wind in your face because you have to overcome very expensive commissions on that strategy. Whereas the same strategy on an index option has a better chance because your commissions are less. Or, contrarian trading without risk management. That's, it's a, public, your show's heard by a lot of people, so I won't mention any names, but receiving guidance from people that were really more in the entertainment business than the trading business, that just expressing their opinions all the time and saying, I have the experience, I've done this for so long, and the market has to go down. And so it's just be short. That's it. That's the whole strategy. Is just be short because the market has to go down. And when it doesn't go down, they're silent. They have nothing, no more guidance for you. And you're left to say, well, what am I supposed to do? And if you don't have the right strategy and you don't have somebody that is showing you whether or not they were even in that position, then you're left on your own. Now you're out there with, frustrated, and you're waiting until you're right. So, being in the right strategies, having people that are actually showing you that they're doing what they're saying they think is going to happen, and giving you guidance as far as day to day, how to get out of it and what to do if things don't go the way they think. The best traders I know, they aren't. I'm not saying they're the best traders in the world, but the best traders that I know at SMB, none of them think that they are going to be right. That's just it. That's all there is to it. They have an idea, and they have a belief that they are skilled and have a good knowledge of the markets, and that they're going to be right more than half the time. And really, it's going to be a number quite bigger than half of the time. But it's still, when they're wrong, they know it's like, I'm wrong. I'm done. I'm out of that one. And it doesn't mean I'm flipping my position. It means I'm wrong and I'm done. I'm out of that one. And you keep the loss small and you move on to the next one where, when you're right, you can have the big win. So it's just some of those kind of psychological things and strategic things where there's so many ways to approach the market that if you just have the wrong combination, you're going to be struggling. So just having the right combination of strategies and psychology to make sure that you have the ability to control your losses when you're wrong, and have the good sized wins when you're right.
Sure. Okay. No, that's a really great answer, Andrew. And something I'd like to go into a little bit deeper on what you mentioned there, and it comes up now and then, is why you shouldn't predict. You shouldn't try and predict the market. But I mean, no one knows what the next one or X number of bars on the right-hand side of their chart are going to be. So what do you mean by you shouldn't try to predict? Because obviously when you execute an order, you're either anticipating that it's going to go up or it's going to go down, and hopefully in your favor, either direction. Could you just expand on that, the reasoning on and the mindset of predicting?
Sure. And this is going to get into just semantics, but hopefully that by going through that, maybe the psychology will come through. If you feel like you are constantly predicting, or if it sounds like predicting, like the market's currently wrong and it has to do this, or this announcement's going to come out and this is what's going to happen, and you basically position yourself with one scenario. If I'm right, I'll be profitable. If I'm wrong, I will lose. If that's the case, then you're going to, especially, and some people don't even go as far to say if I'm wrong, because they just don't think it's possible. They say there's just no logical way that I'm wrong about this, and this is what has to happen, and I have to be in that direction because it's the only thing that makes sense, and they go for it. And if it doesn't work out, it's like their world falls apart, and they freeze. It doesn't make any sense why it didn't happen the way they thought. Then they have no plan of what to do after that. Now we'll go into the part where you're saying you do have to have some kind of bias. You do have to make some kind of assumption about what's going to happen. Well, in options trading, you don't have to make that distinction. You literally can have no directional opinion in options trading and go from that point. Your only opinion may be whether or not volatility will expand or contract in the short term. But even that is not going to be, that's only going to impact in the short term, but not the trade itself. So that's one way that you can remove predictions. And I found that options traders that find good guidance and have discipline have a higher probability of success than directional traders. And that's just from my own personal experience. I don't have some kind of deep, 1,000 person survey to prove that or anything. But my observation and working with a lot of traders and seeing the success rate with the types of traders and seeing traders that failed at directional trading and then learned about non-directional options trading, that they have number one, they have a great chance that they will stop losing money if they have good guidance on the types of strategies and instruments to trade. And then secondly, they have an increased chance of generating some type of positive results by using a systematic non-directional options trade and with the right management strategies. And that's not saying that they're going to make money every month, but if they stick with it for 6 months, in most market conditions, they're going to come out ahead by following those strategies. And they're not going to be home runs, and you're not going to, triple your account this year, but you can make decent income on a decent-sized account. So now I'm going to finish the thought process by saying, now when you do a directional trader, where does that leave them? They are a directional trader, and I said that they can't predict, but they have to have an assumption. The psychology that I would encourage, rather than feeling like a prediction, I would rather have a series of if-then scenarios and several of them. So I would say, if we trade back to this level, then I would consider that a great long opportunity, because it would be a dip in the direction of the trend. Just very simple if-then scenario. If we were to have a dip in the direction of the trend to this level, I think the risk reward would be favorable for a directional trade back to the top of the range, or to a new breakout, and then I would close it when everybody else is buying the breakout. So that's my if-then scenario. Say, well, I don't have to that's not the only way I could make profits on that instrument. I can have a second if-then scenario. If we don't pull back and we break out and we hold, then I can buy a held bid above that level, or if we consolidate above that level for 5 or 6 bars and the bars are getting smaller, then I would also consider that a long opportunity. I don't need the market to come down to my level. I can take advantage of it another way. And I've eliminated predicting what is going to happen. I've given myself 2 ways to profit. Then I can say, if that first one happens and I buy it, and then it breaks the level that I thought was going to hold, now I can have a whole nother series of if-then scenarios. If it holds below that and consolidates, now it's a short opportunity. If it trades back above and consolidates, it's a long opportunity. If it trades back above and takes off, I'm going to skip it. It's not trading in a way that I want to trade, and I'm just going to go on to something else. Those are a number of scenarios where you say, in this scenario, I'm going to have a small loss. In this scenario, I might change my mind and go the other direction. In this scenario, I have a lower probability trade, but I might be able to hold it longer. And you give yourself a number of ways to be in that without needing to say, get in some chat room or get on Twitter and say, XYZ is going to drop 50 cents and I'm going to buy it and it's going to make a new high. And now, because you've made some public proclamation, you feel like that has to happen for you to have any dignity in the world. Rather than that, just say, here's some if-then scenarios. If it gets here, I would try this. And it's a more humble attitude. It's a more adaptive attitude. And you don't feel like you have your pride tied up in what happens next in that stock or ETF or index or anything else.
Yeah, that's really good. I like the idea of the if-then scenario. That's definitely a way to overcome that predicting kind of mindset for sure. And just before we get into a few more of the specifics about how you trade these days, I'd just like to ask you, from the point you started to the point where you reached some sort of level of consistent profitability, what sort of time frame was that period?
There was probably a year and a half that was heavy bleeding and painful and stressful. And then probably a 6-month period of kind of turning away from that. And then, what year is it now? 7 years. So, and then after that, just kind of slowly, and it's been a progressively steeper incline from that. So call it a year and a half of kind of poor results and non-results. And then until I was moving into something that was more sustainable. And then now at this point where, achieving levels as an active trader that you don't hear about in the news and from hedge funds and things like that, just because it's more active and for smaller accounts than these big institutions.
Sure. Okay. No, that's really good. And during that time, like the first 18 months, how active were you trading and how intensively were you studying?
My study was off the charts. Every waking moment that I had, I was reading and studying and back testing and creating charts and creating studies, just going through and watching webinars and reading books and reading information. It really was, 6 a.m. to midnight every day. It was like, that's all I lived and breathed was the markets. And that's just what I felt like I had to do. And I learned a lot in that process, but I was also not consuming the correct information. So I had information overload from bad sources. So from all of that free information that was out there from entertainers rather than, traders that were actually trading professionally and getting real results and sharing their results that they were getting. I don't think that's the process everybody should go through. I think I worked too hard and looked in all the wrong places, and was looking for people that were going to show me how to predict the market or depending on them to predict it and feeling like I could follow blindly along with them. That just, none of that worked out very well. The study was very intensive and the activity was pretty active, probably 5 to 15 trades a day, sometimes more than that, which would have been a bad thing because I would not have been trading strategically. So moderate amount of trading. I wasn't trying to scalp or day trade or find the hot stock of the day or anything like that. I was just probably over managing options trades in the wrong instruments. The commissions were through the roof, really eating into any chance I would have had of making profit, even if I knew what I was doing. All those mistakes, that's kind of what it looked like. So while I was working hard and feeling like the harder I worked, the worse it got. And so at some point I kind of backed off and said, I'm looking around, and as I was getting into the SMB world and I started seeing these traders that had full-time careers and were basically bought 3 courses and learned for a few months, that they got to the point of profitability. I said, well, what's going on here? These guys, they trade like 3 times a week and, then they're doing well. I don't understand this. So that's when I kind of adapted that mentality and got into a little bit calmer state and learning how to trade that way, and it was doing well.
Okay, sure. And just real quick before we move on, while you're studying from say 6 a.m. till midnight most days, you obviously didn't have a job during that period. So what were you doing for an income?
So that was with the group. I was doing some other consulting, and because my background is marketing, so I would do marketing consulting. I did some real estate consulting, and I had some real estate deals that were left over from the brokerage company because commercial real estate deals specifically, a lot of them take, 6 months, 18 months to happen. So I had a lot of deals that were kind of pending that I still had a commission coming on. So those checks were coming on occasion. So it was enough. It was pretty thin, though. There wasn't really a lot of income. And, there was more nights where I was buying ramen noodles and, keeping things nice and easy. But thankfully those days are behind, at least for now. I'm thankful for it, but it's not like that anymore. But I think more importantly, I'm grateful for. I don't even care about what a little extra money coming in does. Mike Bellafiore says he talks to young traders and developing traders and says, "What do you think the greatest part of trading is? Why do you think we do this?" And they say, "The money." And they try to come up with like a deeper answer because they know that's what he's getting at. So like financial freedom and taking care of your family and things like that. He's like, yes, all of that's good. All of that's great. But you could do that anything. You could go out and get a master's degree and be an engineer and do something else. You could get all of that in some other job and industry. So why is it trading though? Why is it trading? And it's freedom and you can make more money and this and that. And Mike, he lets them go on and give all their answers, and he's very consistent in his responses. This is something where it's very challenging and most people don't make it. So when you can achieve and you can get to that point where you say, I went through the rigors and I went through that process and the learning process, and now I can actually do it. And there's that achievement level. It's more of an analogy for a professional athlete that has to work hard to get to a certain level. And, some people call it, you can almost call it like the gamification or the sport of it. That's the part that I'm really enjoying right now, is that confidence. That's something I used to look at and have no clue and used to kind of pound back on me and was challenging. Now I can navigate it from day to day and actually feel like I'm on the right side of things. And it took a long time to get there, but I really enjoy that.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
Okay, Andrew, so let's move along a little bit and shift into some discussion about more about the way in which you trade nowadays. So how would you define your trading method?
The core positions that I'm in are income oriented, and income some kind of has a connotation that it's lower returns, and it can be. You're definitely not going to hit big home runs, but it's definitely better than typical investment returns. But income oriented, market neutral trading of options on the indexes. So that is the core position. Probably, I'm just going to think about the numbers and try to do quick math in my head. Probably 80% of the portfolio is in that style of trading. And then the rest is semi-directional, still has an income approach. Often, probably 90 to 95% of my trades are options, a combination of buying and selling, net short, net long, mostly short options, and then a little bit of futures trading for hedging and for opportunistic swing trades, and a little bit of just more recently in the last few months actually been diving deeper into the SMB equities programs. They have a program now called Trader 90 that's where they have all their tools combined multiple meetings throughout the day talking about equity directional setups. So I've been getting into more of that since the income trading is going well and want to diversify further. But with the income trading, that's oriented to selling market premium in the options market. You have the edge of time decay, which is the one component to options trading that kind of allows you to trade with the wind at your back. If you believe in trend following, you can believe in the trend following of premium decay, which is that it's a constant in the market, and then you just have to mitigate the other risks in that trading. And that's where I orient a lot of my trading to, and that is a probably a steeper learning curve to understand initially, but ultimately when you get through that, a little bit longer learning curve of how those different aspects work together. Options trading is very much 3 and 4 dimensional rather than directional trading, which is 2 dimensional. You can always call it 3 dimensional. You have up, down, and then over time. With options trading, you have volatility and implied volatility considerations and different Greek measurements and things like that. But once you get through that learning curve, then options allows you to have a higher probability of success as you trade from day to day and month to month. So that is basically the style I'm in. I do sell a lot of weekly premium. That took a long time to master because it is a very volatile market. So I do not recommend you hop 2 feet first into the weekly options market without a lot of experience in trading, probably starting with monthlies. Prefer liquid instruments that I can manage actively, but making sure I get enough premium. So there's a lot of criteria involved in making sure you find the right opportunities in the weekly selling market. With individual stocks, I buy options because they are a little bit more erratic and can move faster and further than an index. So I like to buy weeklies on individual stocks based on the defined trend, pullbacks in the trend, consolidations within a trend, things like that. So that's kind of the mix that I have going on right now, but mostly that monthly contracts, index, options trading right now.
Okay, sure. So if you could, for those who might have no idea about the income aspect of options trading, how would you sort of just describe that and just explain that to someone?
Actually, it's good timing you asked me that because just earlier today I was talking to Seth and then a gentleman, Mike Eisner at SMB. We had a conference call and we were discussing that exact topic because we want to bring some of our newer options programs that are really based on I'm going to call them simple strategies, and it's not because they have a lower probability of success or any other factor that makes them less attractive. They're just simple to understand. And we were just discussing on how do you describe this to somebody that doesn't know the options market. And the idea is there's the options market is an insurance market if you look at the fundamentals of it. And I'll just describe it also by paralleling the futures market. The futures market is originally designed, and the purpose of it is for hedging. So if you own a bunch of stocks and you want to short-term lock in the price of those stocks, but you don't want to, say you have a basket of 100 stocks, and they're all different places, and let's say this is back in the old days when they were actually stock certificates, and it was a big to-do to go figure out how to sell all your stock because you thought the market was due for a correction, it was crashing, maybe it was up a lot, so you want to hedge. Whatever that circumstance is, the process of selling was so cumbersome that it was easier to go to the futures market and sell a few futures contracts and have a synthetic hedge. You synthetically reduce your exposure to directional conditions in the market. The options market comes a step further and uses a variety of contracts, calls and puts, that you can buy or sell, and then combinations of those. And it basically creates that same hedging opportunity. You can sell calls, which would limit your upside, but it says if the stock or index rises above this price at or before expiration, then I would I would have the obligation to dispose of this asset at that price to the person that bought the call from me. And then if you buy the put, or if you sell a put, if the market drops below the put contract at or before expiration, then you could be under the obligation to buy the stock or asset at that price from the person that bought the put from you. So, and then you can be on the other end, you can buy. So you'd have the right to execute that contract, but you wouldn't be obligated to do that. So once you get past, that's where the learning curve is. You have to get all of these contracts and long and short puts and calls, premium, buying premium versus selling premium. Once you get through all that, the simpler analogy is it's just like an insurance company. There's the insurer and then there's the insured. The insurance company is selling insurance premium. They are the ones taking on an outsized risk for something that is not necessarily likely to happen. And they do it in the right amount of size, and they do it in a diversified way that they have an edge and they have a good business model. And in fact, as the insurance buyer, you hope they do. You hope they have the capability to fulfill their obligations because you need to be protected in your specific circumstance. So maybe a trader, maybe a highly leveraged investor can own a lot of shares of certain companies that they feel strongly about fundamentally on the long side. However, earnings announcements are coming up, or there's just maybe they have a nice profits kind of run away from the mean in their favor, and they want to defend the position, but fundamentally they have no reason to sell it. So they can go to the options market and buy puts. And they can put a floor on how much risk they have. And that floor is not a stop loss. The stop loss, if it touches that price, you're out. It's done. Your stock is taken away from you. The position is closed, and if it immediately spikes back up in your direction, you're out of the position. You've lost it. So your way of defining risk is a limited opportunity, because if it touches that point any time while the trade is open, you're out of the stock. But if you buy a put, you can own the right to sell it at that price, but you don't have to sell it at that price until expiration. And at expiration, you can either exercise your right, or you can roll the contract, meaning you close that month because it's expiring and you go buy and put in a different month. And that's a way to defend your position without using a stop loss. And it's very common to do that because it adds a little more flexibility. Now, all the benefits of that, the other side of the coin is that happens at a premium. You have to pay a premium value. And when you study it, it's called extrinsic value. It's called options premium. In that, it's just like insurance premium. You have to pay for the right to be covered. And so you pay that extra value. So if you don't use it, that premium goes away. It goes to zero at expiration. So if you buy a 1 month put, it expires a month from now, and you pay $1 per share for that put for a $150 stock, you're going to lose 0.75% on that stock value to defend that position. But if it drops 20% overnight, you're going to lock in, you're going to minimize, and you're going to reduce your exposure. Say the put you bought was 5% below the stock price, and it opens up down 20%. You are capped. You do not lose more than 5% plus the cost of the put. So you would lose 5.75% instead of 20%. And that's the purpose of the options market. Now, if you go in and you are an options seller and you know how to combine various options positions and hedge those, you can actually bet in both directions of the market at the same time, and you have the middle of that position, which is premium decay in both directions, where you either own puts and sell more premium below it, or you can sell calls and sell puts. That increases your odds because usually an options buyer is going to buy in one direction or the other. But if you bought in both directions, you'd be over-insuring, statistically speaking. So you'd have too much premium paid. Well, if you go as a seller, you want to sell too much. You want to sell more than is probably going to be needed to insure those positions. And then you use other management techniques, management from day to day. You can look at your risk and make adjustments when things are changing, or if volatility gets to a certain level, you reduce your exposure. There's a lot of management techniques beyond that. And you can see that from there, it's entirely different. It's a completely different market than stock trading, where you just have a variety of setups that have a probability of either going up or going down. And then that's your directional exposure. It's a very 50-50. When you look over 1,000 trades and 1,000 traders, it's a 50-50 game. Whereas a trader with excellent experience and guidance and using a good system or good strategy is going to be better than 50%. An options trader can pretty much day one with a good system can become 60 or 70% profitable. And they can use management techniques that keep their risk reward very favorable as well. But you have to get through that learning curve of how the options market works. And without the proper learning curve, you have a lot going against you, because there is an outsized risk involved in the options market that the brokers, the market allows you to take amounts of risk that they would not allow you to take on a pure stock trade. So that's a risk that has to be understood and has to be studied very well, or else you could be walking into a lot of pain in the options market.
Okay, that's excellent, Andrew. Thanks for really expanding on that. That's excellent. So while options are, of course, your weapon of choice, the way in which you trade options, I believe, is fairly systematic. So if you could, describe to us, what extent is your approach systematic, and are there still any discretionary aspects to this?
I worked for a very long time to develop systems through a combination of underlying market statistics and signals for both the trend as well as mean reversion. And then I also did a lot of systematic study of option strategies, so different management techniques, selling different strikes with different times expiration, different frequency of management, different ways of looking at directional risk and hedging that from day to day. And my first experience with SMB was as a student, and I was actually taking a course. I'm going to call it a course, but at the time I took it was not a course. It was actually, I asked them, I called up and I talked to Steve Spencer, co-founder, and I said, is anybody there? Could they train me on developing trading algorithms? And he said, let me get back with you. So, and then he got back with me and said, we have an algorithm trader here. He develops systems, and he is developing systems and signals and indicators for the firm, and he would be willing to do a training. So I actually went up to SMB, and this is part of where my, that adding up to my, a little bit more expensive learning experience than most traders go through. But I think it was 10 days I actually spent there the first time on the desk working with Rick Martin, their algorithm and systems trader and trading developer. And that's where I started to learn a lot about the systematic approaches, very rule-based, combining a lot of the tools that you see. So if you see an indicator and you see a system, you can actually just take all of that information and combine it into one set of rules and automate a backtest, automate a report that would tell you how well that would do and what the statistics behind it were. And there are some very excellent algorithms and systems out there. To me, there's a lot of systems that you can develop a back test that has extremely great results, high probabilities of the historic trades working out, excellent equity curves, low drawdowns, big run-ups, doing very well. But when you dig down and you either randomize the information or you move it into the forward market, a lot of those systems break down and don't work. So as far as high probability trading, to be able to develop a fully automated directional system, to me it's just not my psychology. I spent a lot of time working on that, and I got a lot of benefits from it that I'll talk about in a second. But just as far as the study of it and applying it, to answer your question, do I use discretion? discretion is a huge part of my execution trading and my trading decisions. I use systems to guide what I look at. I get signals and alerts on things that are worth trading for a variety of reasons, either pullbacks in the direction of the trend, liquidity, relative implied volatility, things like that, relative strength to the market, a lot of those things, general trendiness signals, consolidation signals on all instruments that I really like that work well and continue from back testing statistics all the way into taking those signals as a discretionary trade, seeing that the wind is really at my back. The trades get easier, the profits are more easy. I don't have to wonder about what's going to happen in the trade. I just know I have a good probability. I put the trade on. I have a reason to exit. I have a reason to take profit, and that's it. So on systems, I believe that studying systematic trading is very valuable. It's actually very valuable for an investor, somebody that's looking for much longer-term holds using a systematic approach. Maybe it could even be a fundamental way of looking at the market and picking a portfolio. There's still a systematic way that Rick taught me, and then together, actually, a couple years later, we then developed a course together to kind of formalize that experience that I went through, which was kind of off the cuff, scheduled. He designed it. We got together and we had a 10-day one-on-one experience to study and learn all of this. And I got to absorb his decades of experience on Wall Street and in Chicago and absorb all that information, process it, stay in communication, develop a lot of systems, did a lot of correspondence and work together, phone calls, went back and visited. And then ultimately it came down to saying, let's formalize this, make it a more of a video series that's a little easier to intake, more affordable because it's recorded. So we put that together. And in that, we actually, in that course, we had a couple-minute period that we talked about what we call the 7 steps to system success, which is whether it's a discretionary, really you can use it to analyze your own discretionary trading is one thing you can do with it. So you're basically analyzing yourself as the system, or you can analyze an indicator. You can analyze a management technique, a filtering system. Say if a filter generates that this is a stock we're trading for the day, and you can just see what the ending result for that day would be on each of those. But whatever it came out to be, these 7 steps are very useful for kind of measuring any type of trading, any style of trading.
Yeah, okay. So those 7 steps which you just mentioned there, I've actually seen that video series and it was really well done. So would it be possible to ask you to briefly run through those 7 steps, just mentioning what each one is, along with just 1 or 2 real quick points?
Yes, got it. The first, there's those 7 steps, and we have them in a specific order. And one of the first things I like to mention is when looking at this, and you can do this for any type of education, when somebody's giving you a list or a bullet point or a summary, you can say, why isn't something in this? And in this circumstance, I always like to point out the fact that the one that we have listed last is last for a reason. And it's without fail. Any system I talk about, one of the most common questions at the very beginning is accuracy. It actually, just today, we have the Options Tribe premium chat room. And the question came up today. We're talking about ratio straddles, where I sell premium at a ratio. So I have a directional opinion, but I also have a market neutral opinion, premium decay, stop losses, automated management, things like that. They're saying the first question, we're kind of bringing up that conversation again, and one of the first questions that got popped in was, and I'll kind of leave some suspense, I won't even tell you, but it was this last point. It's the without fail, it's so common to see the first question be asked is what we feel is one of the least important things to be concerned with in trading. So there's your suspense. So I'll save it for the end. The first one is risk. That is absolutely the first and most important thing. The first is the one at the end, but one of the top ones that's often discussed is what's the return? How much did it make? How much did it make last year? What's the average annual return? How much did it make per week? That's often the first question, is how much did it make? But we like to look at what is the risk? And there's multiple forms of risk. And this series is free. If you go to SMB training, or actually I think you can just Google it. If you just type in 7 steps to system success, it probably, or you can, you're going to link to it probably.
I'll put a link to it in the show notes.
There you go.
So if anyone wants a link, it'll just be at chatwithtraders.com/28. And the link will be just below the interview. So
yeah, that'll be good.
Yeah.
You can go through that and see. But risk, we talk about total capital required to make the trade, average drawdown, average loss, cumulative drawdown, so that's a peak to trough measurement, looking at standard deviation of a loss. A lot of those types of measures, that's most important, because if you have two systems that both make 60% a year on average, and one has 5% drawdowns and the other one has 15% drawdowns. And I have actually a couple more examples where it even goes to the point of showing a system that made less but had a better ratio of drawdowns. When you apply leverage to that, or you randomize that information and you take the same statistics and you repeat it randomly through a program, it actually shows you that it's unreliable or it's less reliable. And when that happens, it means that's something you can't scale up. Nobody's trading because they want to make another $1,000 a month. Everybody that's ever gotten into trading, no matter how small they start, it's without fail. If you know how to do it, you're going to open up an Excel sheet and you're going to do some kind of compounding interest calculation to figure out how quickly you're going to be able to trade bigger so you can make more. And if you don't fully know and understand risk as a mathematical figure in your trading, all of those dreams of compound interest are going to turn into nightmares because you don't understand the big drawdown that's coming. And you have a couple of good weeks or a couple of good months, so then you ramp up your size, and you don't know when that risk that you could have defined by your strategy, that it was going to hit you down too far. So you shouldn't have ramped up so quickly. You should have ramped up a little slower, considering the risk that was probably coming. They do this at SMB on the options desk. They're doing very well. The market's been excellent for market neutral options trading. But the reality is, their flash crash is coming. 2008 is coming, and August 2011 is coming, and which are the harder times. And there's going to be a drawdown month. So they're always taking that into consideration on their trade size, not just ramping up the next month because last month was good. They know the pending risk. They know what's going to happen. And so that's how you pick your trade size and how big you're going to trade and what your expectation is. The second one is reward. You do have to have a positive belief and a positive mathematical and statistical outlook that you're going to have trading profits. So, and they need to be proven by looking back in time at what you've been doing, and they need to be proven in a simulated environment, and they need to be proven forward in the real world. And if you're not getting a reward, if there's not profits, you need to really, don't let psychology say, well, eventually it's going to start working, or I'm going to start tweaking things that I've never considered before and think that's going to make the difference. You have to have a positive expectation of profits. The third one is actually the term expectancy. So I kind of said expectation, but expectancy is an actual math formula that's used for your average win, your average loss times the number of each of those. And that comes down to an expectancy number. It's a very simple calculation that we could almost put this as, I can almost move this up to number one because it's such a valuable number, and there's so many other figures that systematic traders use as far as cumulative average returns, Sharpe ratio, standard deviation of returns, etc. Cumulative or expectancy is a simpler and very straightforward figure that also has the benefit where when you have a single trade on, while that's very difficult to think about the fact that this is 1 out of 1,000 trades, there's going to be 1,000 entries and exits that you're going to experience on a system or through some approach to the market. And when you look at each trade as if whether or not this one works out, or whether if 60% of the next 10 trades or 80% of the next 10 trades work, that has some kind of weight on the system. It's over 1,000. You need to know that every time you pull the trigger, that you're not going to achieve a specific return that is your expectancy number, but you need to psychologically say, as long as I do this right, as long as I follow my rules, as long as I do what I'm supposed to do with this trade, I need to just know that I'm racking up my expectancy number. That every time I do it right, I just say, I earned $23 on this trade because that's my expectancy in this system. Whether or not you lost 10 or you made 60, it doesn't matter. You say my expectancy is $23 per trade, and that's the psychology you have behind using expectancy rather than how often you're right. The fourth one is volatility, which is not necessarily the volatility of the instrument you trade, but it's actually the volatility of returns. So it's basically, it's not simple math, but it is simply proven with math that if you have less volatility of returns, so fewer of your trades are outliers. Most of your profits aren't generated from one or two big wins, and you don't have these sudden larger losses than usual. When you can eliminate those, you have less outliers, you have a better probability of that system working for years and years to come. So looking at different ways of volatility of returns is something that we do. Which one am I on? 5. 5 is frequency. So that is partially psychology, also has to do with transaction costs, that a higher frequency system, especially as a retail trader, instantly has lower probabilities of success because your ratio of cost to expectancy goes up. So that is one of the things behind frequency. Also, your ability to execute, if you're taking the trades manually, goes down because on paper it looks wonderful. In the real world, you realize that sometimes you're sick, sometimes you go to the bathroom, sometimes the power goes out, and there's a lot of things where you can't mess with your statistics because of the fact that you aren't a machine. The sixth one is duration. So that's a kind of a psychology one that lets you know that some systems, trend-oriented systems specifically, are going to have a lot of losses put together. So they're going to have a lot of small losses with very short duration. So you're going to feel like you take a loss, you take a loss, you take a loss, you take a loss. And then you have a trade that starts to go in your favor. Psychologically, you say, I don't want this one to turn into a loss too, so I'm going to take it off. And that becomes the one that makes 10 times more than any of the losses had. Knowing that there are systems like that. I've seen systems with 30% accuracy or less that were fantastic systems because they had tiny little losses when they're wrong. So they just accumulated a few little losses, but they were great setups. They were the times when they could take that small amount of risk and they get wiggled out. They take the setup occurs again. They take a little risk. They get wiggled out. And then the setup occurs. They load up on the position and it goes in their favor. And it goes big and it goes for a long time. So your losses may have been 2-3 hours, and your wins can last 2 weeks and be enormous. So knowing that behind your system lets you know to allow those losses to just happen. Let them accumulate. Let them happen over a short period of time. If the entire market is very stagnant, you may have a lot of stocks, a lot of positions, all experience the same thing at the same time. And right around the time you want to quit and pull the plug, 5 or 6 of those can run in your favor big on that system. So you just have to know what the duration expectancy is. And then the last one, which often is brought up as the most important thing, is the first question I often receive about a system or a strategy that is, I feel, could almost be removed from the list. But there is a purpose for it on the list, so that's why it's still there. And that one is accuracy. Asking how often or how many trades out of 10 or how many trades out of 100 are profitable is probably the most common first question, but it is the least important aspect of trading to know if something is going to be reliable and profitable in the future. The psychology of having to be right is what often brings that up. The psychology of wanting to win often is brought up. The training that we have in school that says if you get if you get less than 70% of the answers right, you are a failure. You have failed at this. And bringing that into the trading world is what keeps a lot of people from becoming profitable and having fun in this market. You have to be willing and understand that you may actually be wrong half the time, and that could lead to excellent results. You could have a 50% success rate and have outstanding results. Because if you're 50% accurate in a trend following approach to the market, so half of your trends run in your favor and half of them have small exits, you're going to be fantastically successful at trading. The reality is trend following is often 35 to 40% accurate. And that's why most people fall in love with the concept of trend following. But then when they try to execute it, they often get shaken out and move on to something else pretty quickly because they get that negative feedback from the market and see that they're accumulating losses. And instinct comes in and says, well, if I'm not getting the results I expected, it's probably wrong and I need to quit. But the reality is you just didn't have the right expectation of how that was going to work out. You probably were misled into being only shown great examples of when something worked, or being shown 2 things that didn't work and 5 things that did. And that sets you up for that expectation that if you do this, you're going to win more often than when you're wrong. And the reality is it's probably not that way. It's probably 7 losses and 3 wins, or 6 losses and 4 wins. That's probably how it is. And you may actually enter where you have 10 losses in a row, or 1 out of 10 works. And that's not enough data to consider something invalid. You have to look at more information than that. So those are the 7 steps in a very abbreviated way. The entire video series that you can opt in and get for free explores that over, I think it's either 7 business days or 7 calendar days that you get those. There's a video and kind of an article that goes with each one of those. So you go through that entire process, and even that is just a very brief snapshot of what Rick and I went into in the Systems Foundation course at SMB, where we really dive deep into all these metrics and ways of looking at different techniques and strategies and how you can measure them and know if they're going to work.
All right, awesome. No, that was really good, Andrew. Thanks for going into so much detail on that. And I'll put the link to that in the show notes at chatwithtraders.com/28. So if anyone's interested in learning more about systematic trading, then definitely check that out. I did, and I got a lot of value from it. So anyway, we should probably start to wind things down, but let me ask you just one more question.
Sure.
And I love to ask this question to a majority of the guests, and that is, what's the number one reason why the majority of traders lose money and never reach a high level of success, in your opinion?
Well, I'll have to just give an answer because I could probably think about this for days and come up with it, but or I might give a mixed answer. One is there's traders enter the market with a lot of confidence because they're either smart, so they may be more intelligent than a lot of their peers, family, or friends, and so they look at the trading market and say, okay, most people fail at this. However, I'm generally smarter. I have good head on my shoulders. When I try to understand something, I do well with it, and I'm also passionate about it. So they say, well, I have what it takes because most of my friends, they're just not even interested. So if they try, they'd probably fail. So I'm probably well suited for success because I have other success in my life. Or I've seen very successful businessmen and investors that in the markets that come to trading, and they get a negative feedback from the market, meaning they lose money, and they approach it the same way they would approach anything else in their life. If it's sports and you're losing, you just practice harder and you try harder and you learn more, and through sheer effort, you're going to be able to improve yourself and get better results. In business, you can work longer hours and you can cut your prices and you can make decisions that you control how you're going to fix it. And you get positive results from that in other areas of your life because you overcome what's going on and you make it work. And traders, those that are attracted to trading, often have that mentality and characteristic. Then you come to the market, and you have to learn very, very quickly that your willpower has no place in the markets. Your willpower to say, I am going to hang on to this trade until I'm right. I'm going to will this system to work. I'm going to will this trade to work. And you just say, I know I'm going to be right. And you take that approach to the market. The worst thing that can happen is that you get rewarded for that a few times. So you call the top in something that's high flying or up big for the day. You call the top and it drops right away. You say, oh, that's great. I should have taken a bigger size. Then it happens again, and you do it again, a little bigger size. And, oh, that was great. And you don't even realize the whole market was consolidating, so every pop was faded. And then all of a sudden, the December rally comes, and the market breaks out. You say, well, I've been conditioned. I know it works. I'm going to short this thing. And then it takes off. The whole market goes up 6%. Your stocks go up 11%. And the whole time you're just trying to will it. You're trying to study. You're trying to figure out why it should go down, why it's got to work out, why you're right. And through some willpower effort, it's going to work out for you. Where the mentality that works is to know when you're wrong and have a understanding that certain there's nobody that's going to be right 100% of the time. And as soon as you are wrong, as soon as you get to a point that has exceeded your expectation of what should happen, that you need to do something about it. And one reason I love options trading is I don't always have to close the position. In my psychology, that works great because I still get to kind of hang on to my idea. But in options trading, I can take other approaches for just kind of defending myself and bringing in a different trade to kind of enhance the position and not really close the original one. It's just kind of a psychological game I get to play that helps me, and it really works out better. But I think that's kind of it, is that they bring in success in other areas of their life. They try to apply it to the market, and but the market doesn't play by the same rules. So I think I'm just going to pick that one. I think that's kind of one may not be a common one that's brought up.
Yeah, that's actually a really unique answer. I don't think anyone's given anything quite from that angle before, so I really like that answer. That's a good one. Now, Andrew, thanks so much for coming on. Now, I know there's quite a few listeners who I've spoken with who are keen to get into options or who might have already started on options. So would you be open to answering any questions that listeners might have in the comments about trading and more specifically around options? Yeah,
that'd be great. You can just let me know or figure out some way that I can be notified when they get posted, and I'd be happy to answer any questions.
For sure, yeah. So if anyone has any if anyone has any questions for Andrew, just go to chatwithtraders.com/28, scroll to the bottom of the page and just leave a comment there. And I'll let you know, Andrew, whenever there's any new questions there, and you can jump onto those.
Great.
Okay, and where can listeners go to find out more about you?
You can go a lot of places to find out about me, but most of my work right now is through SMB Capital and SMB Training, also known as SMBU. So the fastest way to type that in is probably smbu.com. You can also get me on Twitter. So I have a pretty unique first and last name combination. So if you were to Google Twitter, Andrew Faldy, or just Andrew Faldy in general, you'll probably find me in a few different places. And I don't have any other distant relatives or anything with the same name at this point. So I'm pretty easy to find that way as well. So Twitter, Andrew Faldy, or I think it's Andrew F_SMB, but it's pretty hard to miss. But what's any other way? Andrew at andrewfaldy.com is email address. You can send that as well, so it'll come right to me. And then I can add you to my Google Plus, and you can get updates that way as well.
Okay, good one. Well, I'll make sure to put links to everything you just mentioned there in the show notes, including your Twitter handles. So, anyone who wants to find out more about you can just jump onto any of those links. And like I mentioned, I'll also put a link to the video series that you created about system trading. All right, Andrew. Well, thanks so much for coming on the show today and sharing plenty of valuable pointers with everyone listening. Have an awesome week, and let's stay in touch.
All right, you're welcome. Thanks a lot for having me.
Thanks, Andrew.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve risks and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up guys? Welcome back to another episode of the Chat with Traders podcast. I'm your host, Aaron Fifield. This week's guest is Brian Shannon, who first and foremost is a professional trader whose involvement with the market dates back well over 20 years. He's also the author of the highly regarded book, Technical Analysis Using Multiple Timeframes. And thirdly, Brian is the founder of Alpha Trends, an educational company focused on teaching traders how to navigate the market successfully. For the most part, Brian is a swing trader with the occasional day trade in the mix. During the interview, Brian discusses both of these approaches and gives a few pointers that may even help you to discover the right time frame for your own trading. We also talk about understanding the psychology of market participants within well-known patterns, the two indicators that Brian uses most often, and one of them being VWAP, which is volume weighted average price, And Brian also walks us through the 4 stages of a market cycle: accumulation, markup, distribution, and the decline. So all in all, Brian hit on plenty of great topics, and I feel like you're really going to enjoy the insight he shares with us. So I'm your host, Aaron Fifield. This is Chat with Traders, and here is this week's guest, Brian Shannon. Hey Brian, welcome to the podcast. How's it going?
Going well, Aaron. Thanks for having me on here today.
No trouble whatsoever. Thanks so much for coming on. I've really been looking forward to this, and there's plenty I'm keen to discuss with you. And I mean, I really should just say, I've got a ton of notes here, so let's just get right into it. Now, you've been involved with the markets for more than 20 years as a pro, but your first experience with trading dates back much further. Would you like to share with us the story about your first interaction with the markets, and then we'll go deeper from there?
Yeah, my first equities trade was a company called LoJack, and LoJack was I think they're still around, but they track stolen vehicles basically. And this was 25 years ago. I used to sit around and watch Wall Street Week with my dad on Friday nights, and I saw this news broadcast about this technology for stolen vehicles. And I remember, telling my dad, "Hey, I thought that was a pretty cool idea." And he said, "Well, let's buy some of this stock." I think it was $4 a share, and I had maybe $500 saved up from various odd jobs, caddying and that sort of newspaper routes, that sort of thing. And he said, "Well, buy 1,000 shares. You put up your $500. If you lose, you lose the $500, but you make money." So I didn't realize at the time, but he was essentially giving me 8-to-1 leverage on this trade. Fortunately, it worked out, and it went to $10 a share about 6 months later. And, for no other reason than, hey, it's $10 a share, I said, let's sell this. And so I made a profit of $6,000. And from there, I was pretty much instantly hooked and thought, this is great. Why would anyone ever have to work for a living when you can just do the, trade like this? And obviously, it's not that simple. I had some very good beginner luck, and it worked well, though. But that's what really piqued my curiosity.
Yeah, that definitely is some very nice beginner's luck right there. So, what was your sort of motivation to buy that? Like, where did the idea come from to actually put your money into that company when you could have invested in any company that's listed on the market?
Yeah, I had seen on television a local news broadcast saying how that this technology was reluctant to be brought on at first because the state police in Massachusetts didn't want to pay for the transponders to track the stolen vehicles down. So the company said, we're going to donate them to the state police department. And the state police were real excited about it. And I remember hearing one of the cops on television say, "Hey, I think this is great. I even bought stock in it." Found out later that the trooper, basically had inside information when he bought it and had to give his profits back on that. But it didn't prevent me from, coming up with the idea. And I was, probably just a young, impressionable kid who wanted to bond with his dad and thought that this was a great idea and knew that, he was in the market, and we'd been watching Wall Street Week, like I said, and I figured, hey, let's put some of this to work. What do you think, Dad? And he took the initiative to say, okay, let's do it.
Okay, excellent. And just quickly, how active was your dad in the markets? Was he an active trader?
No, my dad, he's retired now, but he's a physician, and he would, he was pretty active, but not by any measure compared to, like what I do today or where my trading has evolved to. He's been more of a buy and hold for, 6 to 12 month type of investments.
Okay, sure. Cool. All right. Well, so from college, moving forward a couple years, you landed a job as a stockbroker. How did that come about, and what sort of tasks were you doing in your role as a stockbroker on sort of a day-to-day basis?
Well, the interesting thing was that I really didn't know what a stockbroker did. And maybe that's naive, but I think it's good too, because I probably wouldn't have gotten into it if I realized what a broker's job was. So, after college, I didn't really know exactly what I wanted to do. I knew I liked the market, and happened to find a brokerage firm that was willing to sponsor me for the Series 7 license. Once that occurred, I went in to the office, and they basically gave us a script and said, start calling off these lists, find phone books, alumni directories, and that sort of thing. And it was after I passed my Series 7 license and was making the calls for a while, I realized that the business was really a glorified telemarketing position, not the trading that I was interested in. So again, probably a little bit naive, but it's it got me in the door. I went to a more established firm, which was Lehman Brothers, and really learned how to sell there more than anything, which was great training. And then just kind of transitioned to trading from there after moving to a couple different brokerage firms.
Okay, so you were mostly on the phones there, trying to convince people to buy stock. Is that correct?
Yeah, and it's I like to kid around about it and say that it was a great experience because I got to practice with other people's money, and I wasn't cavalier with anyone's money that they entrusted me to. But I did learn a lot of good lessons by not having my money in the market and learning how the market worked a little bit. So I was instantly attracted to technical analysis. It made a lot of sense to me. One of the early influences there, I guess, was there was a newsletter called the Cabot Market Letter, and they had written about, they were interested in buying this stock if it got above a certain level. And I thought, well, isn't that strange? Why would somebody want to buy it at a higher price? That seems kind of counterintuitive. So I looked into it, and I saw the chart, and it instantly made sense that if it got above that level of resistance, I didn't even know that's what it was called at the time, but if it got above there, that it looked like it was clear sailing from there. So I ended up getting involved in that stock, made money, and just started to devour everything I could find about technical analysis.
Okay, sure. So you went to the stockbroking firm, and then you went to Lehman Brothers. From there, I believe you ended up trading with a prop firm. What was your experience like trading with a firm, and what was the attraction to actually get into a firm instead of trading your own money just as a retail guy?
Yeah, I think I was 22 or 23 years old when I did that, and it was basically I had saved up some money in the market, and I had seen in the back of Investors Business Daily there was every single week a advertisement for trade with our capital, or use 20 to 1 leverage is what it was. So I was intrigued with that because I figured that I didn't have enough money to really get involved in the market with the amount of capital that I had. So I was still a broker. I answered this ad, went to New York, and met with these guys. And I signed up as a remote trader, and this was 24K modem. And I remember being all excited with a 48K modem, sitting there in my basement trading. And they didn't give a lot of training. That was the thing that they basically said, okay, we'll give you a shot. You get to keep X percentage of your profits. And I had, I basically borrowed some money to put down for that initial $25,000 deposit. And so therefore I was extremely risk averse. And that really helped me. I mean, they say don't trade with scared money. And I don't think it was necessarily scared money, but I was being smart and really people say they don't like to lose, and I say in the market you have to hate to lose. You really have to. When you start feeling something moving against you and you get uncomfortable, you just have to get the heck out of it. So I was fortunate in a way that I wasn't scared money, that I had the opportunity to see how stocks traded, technically through my experiences as a retail broker. So that was great experience for me. And from there, then I helped them, that is the New York firm that I was with, I helped them open an office in Denver and kind of, started branching out that way a little bit.
Okay, sure. And did you mention in there that you were working, or you were trading, remotely from the firm?
Yes. It was, so they were out of New York and they didn't have any local offices. So they were sponsoring people to, trade with their leverage basically. And, they got a piece of the commission and they marked up the commissions a little bit, so that plus the additional profit that they made, that it was a good business model for them, and it was a great opportunity for myself.
Okay, sure. And are there many prop firms that still kind of operate that way today?
Yeah, there are. Yeah, there's still. I mean, if you dig around, you can find them, and they are. A lot of times people are attracted to them. I can't criticize the firms or the people who are attracted to them, because what they typically attract are people with less capital and maybe not a whole lot of education either, but they're willing to give them a shot basically in the market. And I would say that, knowing what I know about the markets today, that I took a huge risk that I would not recommend anyone else do when I did do that account with the prop firm, but it worked for me. So I think that everyone, has the right to make that decision for themselves.
Yeah, absolutely. So you mentioned right there that you took on a huge amount of risk to do this. Did you ever have a backup plan in case this trading thing never took off for you?
Great question. And I can't really say that I had a defined backup plan. It was more, I'm going to make this work one way or another. And I suppose that if it didn't work out, I would have returned to the brokerage business and started, building a book of business that way again.
Okay, sure. So during this time, up until sort of where we are right now in your journey, what would you say was the biggest challenge, within these sort of first 5 years, the biggest challenge or some of the hurdles that you had to overcome that were essentially affecting your P&L in a negative way?
Well, I think it's true for almost anyone that we are our own worst enemies. And, I'm not sure if that's the answer you're looking for, if you're thinking, maybe some external factor. But realistically, I think that we are all our own worst enemy in the market. That even today, I'm still astounded some days about some of the decisions I make during the day, and think, well, I knew better than that. What was I thinking? And to control our impulses and to be more disciplined, to cut losers quickly and to hold winners, real basic stuff, rip pretty much everyone up and continue to plague anyone involved in the market who's honest. We are human. We do get emotionally involved, even though we try not to. And the thing that I've gotten a lot better at is recognizing those times when I'm making poor decisions and saying, enough, just stop, liquidate the position. This is not smart. So it's a matter of probably trading more specifically, maybe I started trading too big and too concentrated in certain positions. But at the same time, right before, I learned a great lesson right before I started with that prop firm, because I was trading a company called Chantel Pharmaceuticals, and they weren't a pharmaceutical, they were a complete fraud actually. They had a miracle skin cream that eliminated wrinkles, and this stock was going, it started out at maybe $6 a share, and I was on it because it had big volume. It was breaking out, and I was trading it up to about 23, 24. I held some over the weekend, one weekend, maybe 1,000 shares at $21 a share. And I remember that Monday morning seeing that the stock was halted, and it was, Barron's did a hit piece on it, and the stock it was basically cut in half, and I lost maybe $8,000 to $12,000. I don't remember the numbers overnight. Right before I was just getting my money together to go trade. So the lesson there was not to have such concentrated positions, especially in little story stocks. And there's so many lessons you learn along the way. But that was one that really stood out for me, that almost eliminated me from ever getting involved with that prop firm.
Okay, sure. So I really like that answer, and that's an excellent example too. While that was probably quite a painful point in your sort of development stage, were there any points where you felt like maybe you weren't just cut out to be a trader and you actually came close to giving up?
Yeah, actually, it was probably I'm just going to say, it was maybe 2000, 2001. At that point, the market was getting crushed, and I had not learned at that point yet that, you can't just keep buying stuff that goes down. And I had a prop trading firm I can't really call it a prop trading firm, more of a people would come in and trade with their own money, and we would help them with getting extra capital. But the market was getting crushed, and I was losing money pretty consistently at that time, just buying stuff in downtrends and expecting that they would bounce, and they weren't bouncing. And I nearly dissolved the account. I was super close. I took a couple weeks and did some reflecting, came back and talked to the partner that I had at that time and said, listen, here's what I need to do. Fortunately, we had a business, and the business was profitable. So I just slowed things way down, and started trading. Maybe, I don't even remember, but half of or a third of my normal size, and just started grinding it back and getting back into it in a more disciplined way, and reevaluating and learning. So I was real close, though, to throwing it away. And if I did not have a backup plan, backup business where I was able to pay bills, then there's no doubt in my mind that I would have been out of the business and no idea what I would be doing today. I was very fortunate, I think.
Okay, right. Yeah, that's really interesting. So let me ask, from when you left the stockbroking firm job to at what point, how long did it take you until you reached a level of consistent profitability? Like, when did things really start to click for you?
Well, I remember my first 6 or 7 months, I was profitable every month, and I was being super disciplined and cutting losses. Then I started to get a little bit of that ego involved, where I thought I knew everything. And then I started to go through a down stage. Fortunately, I kept it limited, and it was really just in evolution, really. The whole thing, obviously, trading in general is an evolution, and you come back to the basic principles. So I kind of got lost on that question there for a moment, but the thing that I would say is that my lessons learned are that the basic things that I still preach to this day, only price pays, follow the trend. I repeat those things a lot of times to remind myself, because that's really the principles of how you make good money in the market. And I believe you get exactly what you deserve in the market, that you can't make excuses that if I lose, it's because I did something stupid, and I hold myself accountable. I can't complain about Greece or China or whatever the news of the day is. I have to recognize the environment we're in and adapt to it, or stand on the sidelines and wait till things make sense.
Yeah, totally. So let's get into that a little bit deeper. So describe to us, if you could, your actual trading style and your methodology for how you approach the markets these days.
Well, my main approach, I mean, sometimes I will do counter trend trades on an intraday basis, but the main approach is that I'm a trend trader and I'm looking for stocks, for instance, in an uptrend, and using multiple time frames. So as I describe it, it's not really quite this simple, but identify a stock on a longer term time frame. So when I'm looking at a swing trade setup, and that's my preferred time frame, is that I want to look for stocks that will last a few days in terms of the trend, if the market warrants it. And obviously there's certain conditions where we've got a choppy market and it's just not feasible. But I'll look for the bigger trend on a daily time frame, and a real very, very simple thing that I look at is what's the direction of the 50-day moving average. Now that will just tell me, okay, if it's rising, well then we're in an uptrend, and I look at that stock and say, okay, that's not a stock I want to short. If the stock has a declining 50-day moving average, I say that's not a stock I want to buy because it's in a downtrend. So I'll look at it and see, has it had a period of volatility contraction, and that is, has it pulled back, and so the uptrending stock, if it's pulled back to a prior level of resistance that looks like it might be support, or a key moving average, or a retracement level, or just something significant technically, then I will say, okay, now on that daily chart, I've identified a possible trade candidate. Then I will go down to a 30-minute chart. So each candle representing 30 minutes for the last 20 to 40 days, whatever I need to kind of see what's relevant, basically. So on that 30-minute time frame, and it's not just a 30-minute time frame, you have to be aware of all the time frames really, but this is again simplifying it. Then I'll look at it and say, okay, on this 30-minute time frame, where has the stock come from? So if it's run 10% in the last 3 days, it tells me the risk reward isn't good there. But if instead we've got a stock in a strong uptrend that's pulled back on diminished volume, and it's starting to undergo a little bit of accumulation on that 30-minute time frame, then I'll start to look a little bit more carefully. And one of the guidelines I use on an intraday intermediate term time frame, such as a 30-minute chart that goes back 20 to 40 days, is a 5-day moving average. And I generally want to buy the stock when it makes a higher high above a flat to rising 5-day moving average. And that tells me the intermediate term trend is now turning back up, and I have a logical place to set my stop, which would be, as I like to say, underneath the most recent and relevant higher low. So that if I see that the entry relative to the initial protective stop is small enough to justify a position, and that the trend on the longer term time frame looks like it should be able to continue in the direction, in this case in an uptrend, then I'll look to say, where's the potential for resistance, or where would it likely slow down? And based on that perceived amount of potential reward, then I come up with a risk reward and say, okay, this is a stock that makes sense. So I use that 30-minute time frame to come up with a risk reward and to plan the trade. And then I'll go down to like a 10-minute chart, each candle representing 10 minutes over the last 10 days or so. And I'll start to anticipate the trade now more. I'll start to stalk it, set alerts. If I think it's going to break out beyond 25.50, I'll set an alert, let's say at $25.40. And then when that alert triggers, I'll start to look at the stock a little bit more carefully. I'll see, what's the overall market doing? Is there, if the market's down and the advanced decline line is let's say 2-to-1 negative, I might, I'd say, well, I still want to look at this stock, but maybe I'll trade smaller share size. And so I start stalking it. I'll reset my alert to 25.45 or 25.48, or I'll start to watch it on a shorter term time frame. And then I want to make my decision based on price only. I don't want to look at it and say, well, the volume's not there yet, because a lot of times people will wait for volume, but the volume will come a day and a half later when the stock has already moved 5 or 6%. So to trust price action, going back to your question of, what lessons have I learned? I think that trusting price action, if you have a good plan and you have a backup plan for it, that really is you're going to get into a lot more trades and not talk yourself out of them because the volume's not there yet, or there was a divergence with the MACD, or, well, I don't like what the NASDAQ is doing, or something like that. So to take each trade based on the merits of that trade individually, and if there are macro concerns about the market or some kind of event coming, to use that for the money management aspect and to reduce my position size to compensate for that higher volatility or perception that we might not be able to follow through as strong as if the entire market was in a better trending condition. So it's a long-winded answer, sorry.
No, that's excellent. That's really good. So
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So, just so we're clear, like you spoke there a lot about price action and focusing on the price itself. How do you treat fundamentals and news? I think you might have briefly touched on that there, but just so we're clear, do the fundamentals and news have any impact on your decisions to get into a trade?
I try to not let them. I am generally aware, so I want to know what are the potential catalysts for a stock. So if for instance, I'm looking at this stock and I think it's a buy, but then I see they're due to report earnings after the close, then I'm not going to trade the stock because I don't want to gamble on earnings. That's a lesson I've learned in the past as well. Gambling on earnings, it's gambling. There's no edge there. So I will be aware of what the catalysts are potentially. I'll be aware of the news headlines at least to try to determine what are the catalysts, what's shaping the psychology in the market today. But I try not to read into it too much and have an opinion of the news itself, because the news is often, I don't want to say made up, but coincident to the price action, not leading, or it's, we can't always trust accountants. We can't trust CEOs that the news is actually what's happening. And that's why I adamantly say over and over again, only price pays, that you can be aware of the headlines and that sort of thing. But market doesn't care what I think about a stock, about what its value is or what it should do based on an earnings report or something. The only thing that's going to pay or hurt is price action. So I would rather lose my opinion than lose my money and move to the sidelines quickly, because you can always reassess the trade and determine to get back in. But there's a tendency to that when we look at the news, we get our egos and our opinions, and we think the need to be right becomes stronger and really, clouds our judgment.
Yeah, okay. No, that's excellent to hear about. Now, this is something you often talk about, and that is focusing on the psychology of patterns and less about the actual pattern itself, like whether it's a cup and handle or a double bottom or whatever it might be. So could you explain perhaps your reasoning for looking at patterns from this angle?
Well, there's nothing wrong with recognizing a pattern, and I often talk about candles, for instance, as well. That some people will be looking at a candle and they'll say, "Hey, that's a doji," and it on the daily time frame. And I'm more interested in what happened underneath the surface. How did that doji come about, that it sold off strong in the morning and might have chopped sideways for a little bit, but then the buyers regained control, and I can see it much better on a shorter term time frame. That is, I can understand the psychology of what's shaping it. And back to the cup and handle, nothing wrong with recognizing these classic technical patterns. And I started like that as well, looking at recognizing technical patterns, but I saw a lot of them fail. And what is it behind there that makes the sense? So a cup and handle, you could train a monkey to recognize cups and handles. You can program a computer to do it. But there's the art of technical the science rather of technical analysis versus the art of trading and understanding, hey, things can and often do go wrong. That is, they don't work out as anticipated the way a technical analysis book will tell you it should. So I want to see that, so a cup and handle, a stock comes up to a certain level of at $80 a share. It runs up to that. It pulls back down to 70 and it runs up to 80 again, but there's still supply there that's unable to be taken out at that point. So the stock backs off again, but instead of backing off down to $70 a share, it finds buyers at $76 a share. It finds support and starts rallying up towards that $80 level again. And then it might even dip down to 78 and then hit the 80 and then break out. So the point is, though, that these higher lows that are being established tell me that the buyers are gaining control price-wise. They're not waiting for the pullback to 70. Instead, they take control at 75. Then they take control at 78. So they're getting more aggressive price-wise. And the time distance between those tests of resistance might be, from the first test of 80, it might have been, to the second test, it might have been a month and a half. And then 4 weeks later, we test that 80 level again, and it pulls back to 78. Then 2 weeks later, it comes back up again. So they're getting more aggressive, not only price-wise with the higher bids where they're taking control, but time-wise that they're coming back more often to test and work through that supply being offered at the $80 level. So if it so you can understand what's happening rather than just saying, hey, that's a cup and handle. I read about those. Those are bullish. I'm going to buy it. It just gives you that better understanding of what the forces are underneath the market. So you want to look at the market and say you're going to have one of three positions. You could be long, you could be short, or you could be in cash. How do the longs feel? How would you feel if you were long? And where would you be getting more aggressive? How would you feel if you're the seller at that $80 level and your supply gets worked through? Or if you're a short seller and you're trying to hold it back at that $80 level? And if you have the ability to be objective and on the sidelines in cash, where do you get involved at the best risk reward standpoint? So it's not really super complicated to try to put yourself, how would I feel if I was long there, if I was short on that stock, or if I'm in cash, should I just ignore this stock, or is there the potential for opportunity in it?
Yeah, you mentioned a lot of great points in that answer, so thanks a lot for sharing that, Brian.
Sure.
Now, I've noticed in your analysis of reading charts that you pay close attention to two indicators. There might be others, but I noticed that you pay extra close attention to these two. So the first would be moving averages, and the other would be VWAP, volume weighted average price. So I'd like to ask about both of these. Well, you sort of already covered the moving averages a little bit earlier. But just on moving averages, they seem to get a bit of a bad rap. A lot of people kind of regard them as maybe a tool for amateurs, or maybe they're just using them incorrectly, or I'm not sure what it is. But have you noticed this, and why do you think this sort of there's, I don't know if a stereotype's the right word, but there's kind of like a stereotype around moving averages as though they're ineffective?
Yeah, I think that a lot of people do misunderstand and misuse moving averages. I look at them as a mathematical trend line, a constant to compare price to over a certain period of time, whether it be 20 days or 50 days or 200. The time is the constant, in other words, in a moving average. And just like we were talking about the psychology of a pattern, I think it's even more important to realize with a moving average, we're all taught that a 50-day moving average is support. I say it tends to act as support. So a stock in a strong uptrend pulls back to a 50-day moving average. People will say that's a buy signal. And to me, it's not a buy signal, but it's a reason to look more carefully at the stock on a shorter term time frame, to look under the surface and see what's actually happening there. Because I can show you thousands of examples where a stock pulls back to the 50-day moving average and just keeps going. That is, it just keeps dropping. So it's the psychology behind that 50-day moving average. If you're a long holder and you bought the stock, let's think of a mutual fund or someone, and they've got millions of shares of this stock, and they bought it at 20, and it runs to 28. And it's 4 points above its 50-day moving average. They might say, hey, it's getting a little extended. Let's start paring our position back. Let's sell some while we can. So they sell a couple 100,000 shares. It pulls back down to the 50-day moving average, and they say, all right, let's not sell anymore, because the 50-day moving average often acts as support. So what they're doing is they're removing supply from the market at that area only because they've observed, they've learned that the 50-day moving average often acts as support. Let's think about a short seller in the same situation who thought, hey, this stock has gotten overheated. Let's sell short some stock. We'll cover it down near the 50-day moving average. So they put the supply on the stock to bring it down to the 50-day moving average. They start to stick in their bids for the stock, and they not only remove one of the sources of supply that helped get it to that 50-day moving average, but then they're also starting to add some demand in there by putting in bids. So the bids are starting to show up, and the stock is losing supply, and we're starting to see that gradual shift. So I want to look underneath the surface and say, is there actual evidence? Let's go back to that 30-minute time frame. Is there actual evidence on the 30-minute time frame that the stock is starting to at least turn sideways, that the pattern we've seen over the last 2 weeks during this pullback of lower highs and lower lows is starting to show more neutral market? So we see less supply. We're starting to see a little bit of demand. And then think about the people, the big mutual fund might say, okay, we sold 200,000 shares between 25 and 28. Here it's at the 50-day moving average. Let's bid for another 100,000 shares. We'll replace part of our position in there and provide support for the stock as well. So they're putting in bids. That's the source of demand. And then you've got your all of the people who look at moving averages and say, hey, the 50-day moving average usually acts as support, so I'm going to stick in a bid there. I want to get involved in this hot stock because it's pulled back to the 50-day moving average. So we start to see that it becomes a self-fulfilling prophecy, this 50-day moving average or a 10-day moving average or whatever the dominant moving average is for that stock on whatever time frame it is, a 200-day moving average, let's say. So there's the psychology behind why do people look at that level. Now let's take it one step further and say, since that stock rallied from 20 to 28 and it's pulling back to 24, we might have another group of people who trade based on Fibonacci. And they're saying, well, it's pulled back to a 50% retracement. 50% has been a good level to buy this stock. So they kind of go through the same process of let's put in our bids here, let's remove supply. And then let's say there's another factor such as the volume-weighted moving average price since that event is in that area. So there's the psychology behind all of these oscillators and indicators that are much more important than just looking at little squiggly lines and saying, okay, that's a buy signal, okay, that's a sell signal.
Okay, excellent. So let's talk about the VWAP. I mean, what is it you like about this indicator, and what separates VWAP from other indicators?
The volume weighted average price, what it does is it takes, so whereas a regular, simple price-based moving average is based on of the average price for whatever period of time you're looking at, it doesn't consider the volume that traded there. So if we have a stock that traded, let's just say, keep it real simple, if you had a stock that traded 100 shares at $20 a share and 10,000 shares at $19 a share, you can't really assign the same value on a moving average to say the average is 19.5. The average is really closer to 1901. Based on volume. So we're looking at it from the supply and demand in terms of the actual dollar amount assigned to a certain price level. And what I like to look at is, for instance, the volume weighted average price since an event. One thing that's been really helpful is, since when a stock breaks out from 20 to 28 and then it begins to pull back, oftentimes you will see that buyers congregate or support is found near the volume weighted average price since that breakout event. Or more recently, I've been tweeting about, for instance, in Alibaba and in GoPro, the volume weighted average price levels since these companies actually became public, and they've both, within the last couple months, shown that, the stocks had some nice bounces and they rallied almost precisely to the level, the volume weighted average price since the stock came public. So there's a lot of psychology assigned to that level. It's the average price. It says above this level, the average participant is making money. Below it, the average participant is losing money, and we can start to, delve into the psychology of the buyers and sellers and see how much they have at stake at certain, they tend to be inflection points. So at those levels, how much do they have at stake, and who's, gaining or losing control there?
All right, cool. So still on the subject of VWAP, do you find that it's more popular within the professional space? And if you do, why do you think that VWAP is maybe underutilized by retail traders?
Well, one of the original uses of the volume weighted average price is for, let's say you work at Fidelity and you want to buy 2 million shares of Alibaba. So you tell your broker, hey, I want to buy 2 million shares over the next 2 weeks, and what I want you to do is to do a good job for me. The way I'm going to measure that is over the next 2 weeks, we're going to see what the volume weighted average price was during that time. If you do better than the volume weighted average price during that time, I'll give you more business. If you do worse than that, I'm going to go to a different brokerage firm and have their traders execute the trade for me. So it's a value comparison for a lot of institutions in that regard. I think, though, that over the last I've been looking at the VWAP for about 12, 13 years, and I actually stumbled upon it. I think that everyone looks at every oscillator and indicator when they first start out looking for that holy grail. And, the VWAP it just kind of spoke to me that it acted as support and resistance. So it is becoming more widely used by retail. Fortunately, not overused. That it's still effective for looking at even intraday in the markets. I'll look at it often on a 1 minute chart and look for who's in control. And if it's got a declining volume weighted average price, generally I don't want to buy it. If it's got an advancing volume weighted average price, that is, the average price has been increasing throughout the day, the transaction level has been increasing throughout the day, then I generally don't want to short that stock. So it's becoming more widely utilized. I like to think I have something to do with that. I've been tweeting about the VWAP and wrote about it in my book in 2008. So I've been tweeting about it and talking about it and writing about it since then. And it is becoming a lot more prevalent with more retail type people.
Okay, sure. No, that's really well said. Now, you spoke a little bit earlier about your time frame analysis, and I just got a few more questions around that. But before we get into it, I think it would be beneficial if you could maybe run us through the 4 phases of market cycles as you see them. I believe you cover this in your book, but if you could just give us sort of a brief overview of the 4 different phases of a market cycle.
Sure. Actually, you know what I would like to do, Aaron, is to send you a copy of the infographic I had made up for that, because it really explains it a lot more in detail, what I'm going to be able to say, and perhaps you can put a link up to it with this podcast. But essentially, it's as I mentioned, when I first started trading, I wanted to I got my hands on as much technical analysis information as I could. And what's always been attractive to me is the simpler analysis. And Stan Weinstein's book from 1986, I believe, or something like that, Secrets for Profiting in Bull and Bear Markets. If any of your readers have or listeners have read that, they'll see it's been a huge influence on my career. I in fact sent a copy of my book to Stan Weinstein, and he praised me for it, and saw that I said, "Hey Stan, this is I've been hugely influenced by your work. I learned this from you, and I want to give you credit." And anyways, the 4 stages, it's goes back to the business cycle. The business cycle being, we have periods of expansion, then we have a peak, then we have a decline and a trough. So we have these 4 stages. And in the market, it's been described as stage 1 is accumulation. Accumulation occurs after a decline. So after a long decline, it doesn't even have to be a long decline. Let's say we're talking about a daily chart, and the stock has experienced a significant pullback. As I like to say, if they don't scare you out, they'll wear you out. So during the stage 4 decline that precedes stage 1 accumulation, what you see is that you've got stubborn holders who hold the stock on the way down. They're not being disciplined. They're not cutting losses. They're still believing the press and the hype around a stock. But in that stage 1 accumulation, what's happening is the stock starts to become indecisive as the supply and demand starts to reach a little bit more of an equilibrium, that you don't see there are these fearful sellers anymore. It starts to turn a little bit more neutral. So that accumulation phase, what we see in there is that it can last a long time, and one of the hallmarks of a accumulation is that we see moving averages crossing back and forth above and below each other. So moving average crossovers represent indecision. A lot of people use them as a timing tool, and I think that's incorrect, because moving average crossovers mean there's a conflict in terms of trend. So a 20-day moving average crossing up and down, up through and then down below a 50-day moving average says, the intermediate and longer term trends are in conflict here. There's no real trend revealing itself. So it's a good avoid. So during that stage 1 accumulation, it's a good stock to avoid. As those longer term moving averages flatten out and begin to, start to turn higher, then you see that the buyers are slowly gaining control. And in that late stage 1 accumulation, that's where you anticipate the breakouts. So as the stock makes a higher high above the flat to advancing longer term moving averages, that's when you want to participate in the stock. So you anticipate in stage 1, you participate in stage 2, and as it makes the higher highs and higher lows, you manage risk and hold on as long as the stock tells you to, based on whatever time frame you're engaged on. So in other words, as long as it makes higher highs and higher lows, you stick with it. And then as it undergoes distribution, we see the opposite of now we see that the stock is not going higher anymore. It's being met with more supply. The moving averages cross back and forth, representing indecision, and it's either digesting those gains through time before a breakout, or if it breaks down, then we look at it and say, okay, now the moving averages are heading lower. This is a stage 4 decline. That stock is an avoid if you're just a long trader, or it's a short sale candidate. So those 4 stages allow you to just kind of very simply look at the market or an individual stock and say, who's in control, buyers or sellers, or is it unclear? And if it's unclear, the beauty of that is that's just an avoid. There's no reason to go near that stock, and give it some time, keep it on your watch list, come back to it, but there's no reason to be involved in a stock that's just going sideways.
Yeah, well, there's always plenty of others to choose from, isn't there?
Exactly.
If you can send through that infographic, I'll post it with the show notes underneath this episode.
Yeah, of course.
At Chat with Traders on the site. So I have a question in regards to time frames, and how did you discover the time frame which was the best fit for your personality to trade? Like past guests on the show have mentioned quite a few times that many traders often spend a long time working with a time frame that isn't necessarily the best fit for them. So how did you discover a time frame that worked well for you?
Well, and that's a great point. And going back to your, what lessons have been important understanding your time frame is hugely important. And if you have the patience of someone like Warren Buffett, then you've got no business looking at an intraday chart for what happened for one day. But if you're maybe a little bit more, I think a lot of traders tend to be a little bit ADD and hop around a little bit from stock to stock looking for the action, then you shouldn't be looking at what pays the best dividend. So it comes with, like a lot of success in the market, with understanding yourself personally and what works best for you. How much time do you have to commit to the market? Can you sit down in front of the market each day and be on task and pay attention to the micro movements and be patient enough to not just get emotionally involved because you're bored and I'm a trader, so I should be trading type mentality. So how much time do you have? How much capital do you have? How much experience do you have? No one should start out with day trading. Day trading is something you evolve, or some people might say devolve to. But because there's, the more often that you're confronted with having to make a decision in the market, the more often it is, the more likely it is that your emotions are going to creep into the decision-making process, and you're not going to be able to control yourself as well. So you start out, everyone should start out with a longer-term horizon, whether it's a couple months or swing trading is really an ideal type of time frame because it gives you the opportunity to get feedback on your trades within a couple weeks, generally, and you can learn and hone in on things a little bit better. You don't have to be watching tick by tick. But if you are the type of person who can sit in front of the machine and pay attention, control your impulses, and you've been successful on the couple month horizon, then down to a successful swing trader, if you can do that successfully, then you start to experiment with day trading. It's a great skill to have. It's not appropriate all the times when you've got a choppy market environment. It's a great skill to have because it allows you to put some money in your account without exposing yourself to overnight risk where we might have a market that's gapping on a frequent basis. So it's a great tool. It's a skill. It's certainly not appropriate for everyone. And to start out just trying to day trade is something I would tell anyone that you're a fool if you try to just start by day trading.
Yeah, okay. So I think a lot of people who are probably quite new to trading are often attracted to the idea of day trading with the mindset that you're taking more trades, you can make more money than whether if you're swing trading, you might only take a few trades a week. Do you believe that you can make just as much money as a swing trader as someone who's a day trader? Like, is there any time frame that makes more money?
I think swing traders make more money than strictly day trades. All of the trades that I look for, I'm looking for a swing trade opportunity. I would ideally like to hold all of my stocks on for a few days to weeks. However, the market gives me new information throughout the day, and I have an opportunity to maybe lock in some profits or avoid a loss. So I will, the market will tell me basically it's not appropriate for me to hold. So I will day trade it instead. And I will say that I also tend to have a personality that lends myself to probably a little bit more day trading than I should be doing. But it's also kind of kept me in the business at the same time that I'm not willing to sit with a loser long enough to cause damage or to hit a stop that's 5% away when I can cut my loss at 1% because I see the handwriting on the wall. And that's just something that comes with experience.
Okay, no, that's a great answer. So, all right, Brian, well, this has been really, really good, but we should probably start to wrap things up. So let me just ask you one last question. And in your opinion, what is the reason for why the majority of traders lose money and never reach a high level of success? Why is there such a high turnover in this business?
Well, it's an extremely difficult business. Anyone that tells you that it's easy is lying, being misleading. It's a difficult business. You have to have capital to start, but there's no barrier to getting involved. Let's say as a day trader, when from day one, when you shouldn't. I think that people get impatient with the market. They don't find out who they are and what their personality and their appropriate time frame is in the market until after they've made too many big mistakes. So that they want to get involved in the market and they see it as the opportunity for a way to make easy money, when in fact it's extremely difficult. And it comes first with mastering yourself, or no one masters their self, but having a much better understanding of yourself. So I think it's impatience and then ego that when they get into a trade and they see that it starts going against them, they start pulling up news, they start looking for other opinions. Their ego doesn't allow them to take that quick loser when they meant to, when they went in with a plan and said, I'm going to cut my loss here, but then their ego gets in the way and says, no, just buy a little bit more, it's definitely going to bounce, and they compound their problems. So not understanding their time frame and being impatient and not learning the mechanics of how the market actually trades, and understanding the psychology of the flows of money without before they start sizing up their positions and getting involved with too big a share size, or just saying, hey, I like Apple, so I'm going to buy Apple. Well, Apple's not always a buy. All stocks go through that cyclical phase where they go through a stage 4 decline.
Yeah, what a great answer. Okay, Brian, well, we've hit on a ton of great points during this interview. And again, thanks so much for coming on and sharing a whole lot of knowledge with us. This has been really good. Before you go, can you share with listeners where they can go to find out more about you?
Yeah, alphatrends.net, and StockTwits, it's at AlphaTrends. So you can find my book also on Amazon or technicalanalysisbook.com. And I'm pretty easy to find on the web.
Okay, great. And your book title is Technical Analysis Using Multiple Timeframes. So we'll put a link to that in the show notes at chatwithtraders.com/29. This will be episode 29. And you're also
congrats on that too.
Thank you.
On 29 episodes, yeah. Nicely done.
Yeah, one a week. We're not slowing down. So you're also on Twitter as well, aren't you?
Yes, at AlphaTrends.
Okay.
ALPHATRENDS.
Great. All right. Well, all those links, of course, will be in the show notes at chatwithtraders.com/29. So you can go there to, get a recap on this episode and all the links mentioned to find out more about Brian. All right, Brian. Well, again, thanks so much for doing this, man. Take care, and let's talk soon.
Excellent. Thanks again, Aaron.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve risks and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey guys, what's up? Welcome back to another episode of the Chat with Traders podcast. This is episode number 30, and thank you so much for taking the time to tune into another episode of the podcast. It's awesome to have you listening. Now, this week, we're taking things up a level. I had the honor of interviewing the legendary market wizard Tom Baso, president of former money management firm Trendstat. Tom started his working life as a chemical engineer, often discussing stocks and investing with colleagues. As he started to experiment with trading from a $2,000 account, there was no beginner's luck in sight. Tom consecutively lost money for the first few years before things started to turn around. With a series of events that followed, Tom went from trading his own money to forming Trendstat and managing other people's money. At the peak of his career, Trendstat managed $600 million of capital. And while Tom's now retired, he still actively studies and continues to trade. This week's interview covers many topics that range from trend following and systematic trading to psychology and why you must never forget to enjoy the ride, which is most important of all. Just before we roll into it, I'd like to highlight there were a number of challenges recording this interview. Firstly, this was recorded a few weeks ago when I was fighting through a cold, and we had some challenges with the audio equipment. And we also had to record this interview in two parts. Then just to top it off, there was a thunderstorm that rolled through midway. But I'm hoping you can look past this because the knowledge and experiences that Tom shares over the next hour or so is invaluable. All right, guys, I'm your host, Aaron Fifield. This is Chat with Traders, and here is this week's guest, Tom Baso. Hey, Tom, how are you?
I'm doing fine, Aaron.
Excellent. Great to hear. I mean, it's awesome to be speaking with you, and I must say before I go any further, thanks so much for being open to an interview and making the time to come on. It's really a true honor to be speaking with you.
It's totally my pleasure.
Yeah, so I mean, like earlier this week, I was going through, I reread your Market Wizards interview and I listened to a bunch of your interviews on Michael Coville's podcast, and they were all really insightful. And so I'm excited to hear what you're about to share with us today. And I mean, there's no doubt that listeners are going to take away a lot of valuable wisdom from this discussion. So just before we get into it too much further, for those who may not already be familiar with you, they might just be getting into trading or just starting to get into the world of finance, would you like to give us just a quick 30-second snapshot of who you are and kind of what you're most well known for? And then I've got a bunch of questions about where it all began for you.
Sure. I'm, of course, the former creator and president of Trendstat Capital Management. We had about a 28-year run or so. I started out as a chemical engineer and got into trading, and one thing led to another. First I was trading stocks, and I got into bonds a little bit and traded a few options and got into futures trading, expanded that to about 80 different markets in futures, and eventually got into currency trading, which is the bulk of our money at the end. But we still traded mutual funds and futures, and at our peak we handled about $600 million of other people's monies. We were registered commodity trading advisors in the U.S. and registered investment advisors as well in the U.S. Shut that down in 2003 and enjoying retirement the last 12 years or so.
Okay, that's excellent. I mean, that's a really impressive way to kick this off. So I'm keen to hear how you very first got into trading and what was it that initially attracted you to the financial markets?
Well, what happened is, as a chemical engineer, I realized that there was sort of boom and bust in the United States in the economy. And every time there was a boom, they'd hire engineers, and every time there was a bust, they'd lay them off. And not wanting to get laid off and at least wanting to have a backup plan, I decided I'd better save some money as I was earning it. And as that got to be a little bit of a larger quantity of money, I decided I should do something with it rather than sticking it in the bank. And some friends of mine that were also chemical engineers at lunch would talk about the stock market, so that intrigued me, and we started a stock portfolio, and so I could participate in the conversations as well, and that led to an investment club where we ended up eventually running the club, and that ended up into a small investment advisory business, and teamed up with another couple fellas and got that going. That grew into a substantial size, and I eventually sold my share of that company and formed TrendStat. And TrendStat then was my way of trying to not only manage my own money, but manage my client monies as well. And we just kept growing that over time and evolving in complexity, number of markets, and so on until we became the success that we became.
Okay, excellent. So let me just take it back to when you mentioned there that you sort of started out as a chemical engineer. Were there any skill sets that you learnt as an engineer which you applied to trading or had some sort of relevance when you sort of brought it over to the markets?
Yeah, the most obvious one that I have noticed over the years, and it certainly applied throughout my TrendStat years in the company, was something called process engineering. And what I refer to that as is one of the first lessons you learn as a chemical engineer is the old pipeline comes into a tank, the tank is full of water, and there's a pipeline going out of the tank. And you learn how different flows coming into the tank will fill the tank over certain amounts of time. And you'll learn that flows going out take water out over time. And when you have them coming in and going out at different rates, then you need to be able to calculate how much water is going to go up or down in the tank. And so process engineering in my mind always becomes stuff coming in, stuff being processed, and stuff shipping out. And TrendStat Capital Management was a perfect example of that. We had all sorts of downlinks and internet connections and everything, bringing in data continuously, in some cases tick by tick. Then we were an operation that did nothing but process that information. So we had 40 computers and 10 people at our max that were just doing nothing but crunching a lot of data. And then there's the flow out, the orders, the communiques, the updates to websites, and all that. So to me, that was just process engineering. Bring in the information, process the information, ship information out. And the faster and better and more efficient you can do that, the better off you're going to be.
Yeah, okay, that's really interesting. So just still sort of sticking with that journey as you were starting out, if we were to zoom in on your first few years, what do you recall your experience being like?
Well, the first thing that comes to mind brings a smile, because the first few years, I would say, were pretty much losses and me making mistakes and just sort of wandering and trying to find my way. I looked at things like fundamentals and I took several newsletters, and I read opinion after opinion to the point where I was totally confused. And I realized that sooner or later, a trader has to take individual responsibility for what he or she is going to do. And the only way you're going to do that is to simplify everything down so that you can say, this is how I'm going to trade. I'm going to take this data, I'm going to examine it or process it, and there's going to be a flow of orders that goes away from me. And when I do that efficiently and religiously and in terms of disciplined, that's where I'm going to be able to analyze whether that approach is working or not working, modify it if it's not working, improve it, and keep getting better and better as a trader. And so the first couple of years were actually losing years, and it required a tremendous amount of foresight, strategic knowledge, and patience on my part to just keep doing it, because it's kind of like, how many times do you want to beat your head against the wall before you stop? And there was certainly plenty of that in the first few years.
Okay, that's great, Tom. So I think it's fair to say most of us will probably never forget our very first trade. So tell us, do you remember your first trade, and how did that turn out for you?
I don't remember the specific trade, but I would remember that it was a stock that I bought, and I think I bought it based on somebody having a hot tip. I want to say it was Alcan Aluminum, somehow way back when. And I realized well into the trade that I had no idea how this particular tip that I was given had anything to do with the financial well-being of Alcan Aluminum, and that I had no idea how to get out of the thing once I got into it. I didn't even have the ability to chart it or do anything. So I just really felt like completely a fish out of water. I had no idea what I was doing. I realized it fairly quickly, and thankfully did not lose too much money on that one. I did lose, I believe, but I thought it was an interesting educational experience.
Okay, sure. And I mean, you touched on this sort of a little bit earlier, and I think I read this in your Market Wizards interview, but is it true that when you very first started, you actually lost money for 5 years consecutively, sort of one after another?
That would be referring, Aaron, to my commodities trading. I took about, I think it was the fourth year, perhaps, where I at least broke even. So I traded for, first year lost money, next year lost less money, next year lost less money, finally broke even, and it probably took me to about 4 or 5 years roughly to where I was actually producing a reasonable profit.
Okay, so I think there's a couple really valuable sort of notes we can touch on there. The first one would be, how were you able to lose money for 4 or 5 years, yet continue trading? And secondly, what was it that motivated you to keep pushing on and not to give up?
Okay, the first question is, in terms of how was I able to keep doing it, is I was a chemical engineer. I was actually at a day job. I was making good money. We were in great demand back in the oil embargo days in the 70s and 80s. And I ended up with a nice job, lots of promotions. I was highly ranked in my daytime job. I always got the best raise, the best promotion, and eventually had moved over into the business side of the chemical industry, and was still trying to advance down that road while I was trying to become a better trader at the same time. And because of that, I had cash flow, and because I always kept my trading very small, and as I was trading and losing small amounts of money, I was easily able to not only replace the losses, but to increase the size of my account, to improve diversification, to improve the numbers of volatility and risk controls and things that I was learning how to do at the early stages. Some of that just requires more capital, and I just worked real hard and tried to save as much as I could and keep adding to the account. And why I was able to keep going was that I saw that every year, when I looked back at the year and tried to decide what was going to, which direction am I taking in the future for the coming year, I could always see that I had made progress, that I had made less mistakes, that I lost less money, that I had captured more of the types of moves that I was trying to capture. And it kept me thinking that I'm on the right path and I just need to keep refining it and getting better and getting more diversified and keep my costs down. And little by little, I finally got there. It took a long time.
Okay, good one. And just looking back on that time, of course, with the power of hindsight, is there any way that you feel as though you could have potentially shortened that learning curve from the point of first starting out to where you've reached a level of profitability?
Well, yeah, in today's world, I probably could a little bit in that there's all sorts of, some of the brokers will give you free practice trading types of softwares and on the websites and things that would allow you to run tests that for very little or no money as an inducement to get you to trade your account through them. Interactive Brokers comes to mind, interactivebrokers.com, and but there's others too. And there's lots of software that you can either buy or use in various levels of sophistication that would allow you to test certain ideas out and cover a variety of data. In my days, I literally had Wall Street journals. I saved everyone religiously. When I did a study, it would be pulling out the Wall Street Journal day after day after day after day and sticking it on a piece of paper, because mini computers or microcomputers hadn't even been invented yet. So I'm doing this all by hand. I'm using chart paper to chart the things, and I'm running a study over a course of a couple years of data. It would take me an entire weekend to just try to run some idea on one particular market for maybe a few years of data by the time I was all done. And it just cumbersome and tediously boring and tediously slow to get it done. But I knew that once I had certain things done, that I could use that and understand what I was going to get on the good side and what I was going to get on the bad side. It also forced me as a trader to live in the moment of those trades day by day, in the data, in the historical data. So many times I think today traders have such fancy, sophisticated software that you can run 20 years of data against 60 different markets and you get some number at the end that says you made 12%. And there's no understanding of how that 12% was made in the detail. It's just the final page of the study that comes out and it gives you all these fancy statistics. You say, oh, I like that, I'll do that. But you don't live with the trades day by day and realize the types of things that could have happened intra-trade that you have to be able to psychologically live with. Well, because I was doing everything by hand, I guess good or bad, it was good that I ended up being able to really understand how a trade evolved day by day, because I was doing it all by hand. There wasn't any computer program back in those days.
Sure, that's really interesting. And like you mentioned, the Wall Street Journal there, was there anything else you were doing to sort of educate yourself on the subject of trading?
Read a lot of books, and we had our lunchtime crowd that would exchange ideas. Those were the two ways I kept expanding my brains.
And during this period up to your first maybe 10 years in the markets, were there any points that forever changed the way you approached trading, like any aha moments, realizations, or sort of hard lessons that will forever stick with you?
There was one that I talked to Jack Schwager about in New Market Wizards that is etched on my memory, and it involved the Hunt corner on silver way back when. I can't even remember the year anymore. I'm going to say it was in the 80s. And I was long silver, as I was supposed to be. And I had about, I think at that time my futures account might have been, I'm guessing between 70 to 100,000, right in there. It gotten to be a decent size account now, but it was relatively small. And all of a sudden, silver starts screaming upward, and I've got, I forget how many, like 4 or 5 contracts of this stuff. And I'm looking at my equity in my account, and today it's 125,000. The next one it's 150,000. It's 175,000. It's 200,000. It got all the way up to 500,000 on this one trade, and my account was going up and down 25 to 50,000 a day. As they got near the top, it got very frothy. And darn it, I'm a good trend follower at that point. I'm going to stay with this trade and let the trade run, let the winner run, cut the losses short. You know, that's the rules. You got to do it. And I was just so disciplined about it. And by the time it got back to my stop loss point, which I had moved up and followed the trend, I ended up netting out about a $250,000 account out of it, and which on the surface of everything would seem to be, you know, what's wrong with that, right? I mean, we started with 50 or 75, and we ended up with 250. That's a good trade, and it certainly was very profitable. But when I sat back at the end of it, and I thought of the nerves that I had to put up with to live through that trade, I thought, wait a second, should I have really had 5 contracts or whatever it was throughout this entire trade? Or would it have made more sense to have a proper exposure and to stay with the trade during the entire trade all the way to the end, but when the markets got insane, to hold less of that position so that as a portfolio, all of my instruments in the portfolio would have a somewhat equivalent ability to produce profit or to create loss, and they would be able to diversify each other a little bit. In this one case, the silver so dominated my portfolio that I might as well not even been trading anything else. And I thought that didn't seem right to me, so I started doing a lot of research on volatility as a percent of equity in my portfolio, and started from that point on creating the early stages of what Trendstat eventually very successfully used over the years, which was our volatility controls. And along with that, the risk controls evolved, and we used those at Trendstat as well, which was limiting the risk of the particular market to my portfolio and limiting the volatility that it contributes to the portfolio, both as a percent of equity. I think once I had those two things in place, performance got a little more predictable, got a little bit more consistent. Profitability got, I think, strangely a little better. I guess it allowed me to put the proper number of contracts on so that one market didn't dominate the losses too much. But that led to, I ended up ultimately, even with margin, as a percent of equity controls in a couple of instances in Trendstat, and we had the ability then to put together real portfolios that had real diversification, that had real abilities to have all the markets help contribute to the profits or losses. And that was a real aha moment to me because living through that silver trade, wow, that pretty much is the way to keep yourself up at night.
Something I just want to touch on that you mentioned there, and that was about volatility control as a percentage of equity. Can you just elaborate on sort of what you really mean by that, and maybe how this is something that other traders could adapt to better sort of manage their capital?
Sure, it's easy to do, and I'll give you the exact formula. It's take a market and figure out for one contract of a futures market, figure out how much the highest high of the day and the lowest low of the day is worth, is a range in dollars or whatever currency you're living with, in our case, US dollars. And you'll come up with that number, and that's its volatility of one contract for that market for that day. I would average, I use an exponential average, but you can use whatever you want. It all works similarly. I'd use a 20-day average of that daily volatility. So that gives me sort of the last 20 days of how much is this thing moving up and down. Is it moving up and down per contract $1,000? Is it moving up and down $200? Is it moving up $500? Whatever it is, it's just telling you that this is how much this thing has speed to it. It is going to dominate, it's going to contribute when it's going your direction that much per day, and it's going to potentially hurt you that much a day if you're in the wrong way. Once you have that number, then I just divided it by the dollars of equity in my account. So let's say you're trading $100,000 and that particular market was moving highest high to lowest low, it would be maybe $1,000 in any one day. Well, that one contract would then have a 1% volatility to equity. 1,000 divided by 100,000. Now, what I used to do, and I can't even remember the numbers now, it's been so long, but we used to set at Trendstat for some 80 different markets we ultimately traded. Each market would have a very specific, by how we were trading it, level of volatility that it would be capped at, and we would never let it get above that. So every day, the computers would take in the data, recrunch the 20-day moving average of the volatility, recrunch the equity that we now have because we either made money or lost money today, so the equity's changed, come up with a new percent equity for percent volatility to equity of every single of the 80 markets. It would compare them to the allowed limit of each of those markets, and it would give us a set of orders to peel off markets if we ever had any that got over the volatility level. And we would just sell them off at market the next day.
Okay, excellent. Thanks for sharing that with us, Tom. That's really good.
Mm-hmm.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory exchange and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
Something I'm keen to ask you about, and that's kind of your mindset and where you were at sort of in your head during your sort of 20s when you were getting into trading there during those early years. Did you always envision yourself as reaching the high levels of success that you were able to achieve? I'm always interested to know if you like had that long-term vision and a long-term goal that you were sort of working towards. You knew where you wanted to get it. You knew where you wanted to get. It was just a matter of how you were going to get there. Like, did you always picture you would reach the massive success that you reached later in life?
I didn't even picture that I would be a professional money manager when I started out. I was a chemical engineer. I was simply looking for a way of trying to manage some money on the side, and I assumed that if I was successful at running my own portfolio, I perhaps could retire a few years early from being a chemical engineer. But I was happy at the early stages of being a chemical engineer. I was paid very well for it. Chemical engineers, when they came out my year in '74, were one of the highest paid engineering disciplines because of the oil embargoes and everything. So life was pretty good for a young single 20-something that's making more money than he's spending, and it's piling up in his account, and he is learning how to trade, and I just assumed it would be a side portfolio, and that I would somehow be able to increase my net worth, and I'd have the backup in case I was ever laid off, and life was good. Little by little, what happened was, as people found out I was having some success with my own portfolio, the investment club evolved into sort of, hey, why don't you do what you're doing for yourself with some of our money? That led to a certain limit on the number of people I could do that for before all of a sudden now you got registered as an investment advisor, and then running into two other friends that ended up getting into the investment advisory business with me, and little by little things just, I still figured we'd just do this on the side and do it part-time at night or on weekends, and it'd be a second source of potential income. But it was still just a way to manage the money and defray the expenses of taking all these services, and the cost of registration in the U.S. is, there's some money involved in that. And what ended up happening, much to my amazement, is on a part-time basis, we ended up making enough money off of our business to where we could pay one salary full-time. So I said to my two partners, I said, you guys have kids and all that, and you can't really travel. You're tied down a bit more. I'm still, I don't have any children. I got a lot of flexibility. How about if the company pays me my salary that I'm making now at the chemical company, and allow me to leave and open up the offices, and let's take this serious and make it a full-time, successful business. They agreed. I left, started everything, started traveling and meeting clients and putting business on the books and creating computer systems and hiring secretaries and signing office leases and doing all the things that you have to do. And one thing led to another, and pretty soon I got the second partner out, and before long the third partner joins us. We add more staff. The whole thing becomes a wild success.
That's excellent. So let's get into that a little bit deeper about once TrendStat was formed, and talk to us about how you were trading at TrendStat. I believe that it was a totally systematic sort of operation. So can you just sort of shed some light on that topic?
Yeah, TrendStat really, the name of the company was coined by myself, and it's just the trend following statistics. Abbreviated to TrendStat. STAT is statistics, and trend is the trend following or trend of the markets. And I felt like if you could just take and collect lots of data on lots of different markets, determine the trend, and then always position the portfolios in line with whatever that trend was, that over time there were going to be large movements, large trends that ended up paying your way for the most part. A good statistic that I would cite was in the first year at TrendStat, I did an analysis of where we made money and where we lost money, and I actually ranked the trades from the most profitable trade during the year to all the way down to the largest loser of the year. And we were running about 30-something% reliable in terms of our trading. That is to say, 30% of our trades would be profitable and 70% of them would be losers. But it turns out that one year, 2 trades that were so largely profitable that if you had not gotten those 2 trades in your portfolio, you would have broken even for the year. That's how lopsided it was to the 2 trades that ended up being so blockbuster and so unbelievable that you had to have them in your portfolio. If you didn't, you were just going to break even that year. That got me thinking, I've got to make sure, you know, with no excuses, that I always get every one of those 2 or 3 large trades every year that are going to be there for the most part over time. And those are going to be what's going to pave the way. And the rest of it is a whole bunch of hard work to get nowhere. And that was really what led me to the kind of just expanding the number of markets that I traded, because it put bets, if you will, in more markets, giving you that many more opportunities to catch that 1 or 2 in those particular markets. And I never knew which market ahead of time or which trade I was making was going to be that big winner, but I wanted to make sure that I had as many chances of catching them as possible. And so I just kept buying more and more computers, and we had at the peak, including myself as an engineer, we had 3 full-time computer experts that were doing everything from programming to hardware to keeping the networks running to backing things up to backup facilities off-site, all sorts of things. And it just became a data processing facility, really. A lot of people used to think of me, and still do, as a trader, and yet a lot of times when I was in the middle of Trendstat, I was thinking of myself as the president of this data processing company more than I was a trader. I realized, looking back at it, I definitely was a trader. I had to create all these programs. I had to tell my programming people what I was trying to go for, and that was being a trader. But you know, if you woke up and followed me around all day, you'd kind of be wondering how would anybody think that I was a trader?
Yeah, I think that's really interesting, actually, how you sort of mentioned that, and you sort of almost called yourself or the company just the data processing hub, pretty much, instead of a sort of what you typically think of when you think of a trader. I think that's quite funny. So generally speaking, was there any human interaction with the trading systems during a typical trading day at Trendstat there?
No, there was zero. What we did was we built lots and lots of computer programs that we would take data in. We would run the programs once a day against that data, and then decisions would be made by the algorithms that we had built into the computers, and prints would come off, and the human beings would just scan it to look for any kind of computer malfunctions or data malfunctions or anything that looked strange to anybody. Because that would be the last chance we would have to catch an error that maybe of our computers through our poor programming perhaps might have created. But once we knew that everything looked normal, the data looked normal, the data passed all the data checks that we did, the orders were created, hit the button, and out they go. And all of that was automated. The only thing the human beings would have to do is start the process to run the orders, visually scan them to see if anything looks strange, and hit a button to transmit them all. That was the only thing the humans did.
Okay, sure. So Trendstat was sort of in full effect during, I think it was sort of the 90s, is that correct?
Yes, in various stages.
Okay, so during that time period, was this approach common amongst money management firms, or was this quite sort of new to the space of money management, this sort of systematic and automated approach? Was the technology that you were using reasonably cutting edge for the time?
I would put it this way. I would say that cutting edge would mean very different things to different people, I think. If it was at all cutting edge, it would be sort of us trying to take a longer-term trading strategy across a lot of markets and automate that process. I do believe that during the 90s there were automated traders out there, but they were probably doing more intraday trading and what would you call straddle trading, pairs trading, those types of things. It seemed like a lot of the automation was concentrating more on the very short term, and we were just the opposite, concentrating on fairly long term, but doing it in a systematic way. So we were probably unusual in that regard.
Okay, sure. And I mean, I probably should have asked this a little bit earlier, but what was the initial appeal that attracted you to a systematic approach?
That's a good question. I would call it laziness, human being laziness. When I was doing my initial work and I had to have my chart paper out and burn my eyes up every night trying to go through all what the markets did and put in my new data and figure out where my orders were and then create some kind of a fax and then ship that to the trading desk and have them put my orders in for the next day. It was a lot of work. And I realized when personal computers came out, and I was an engineer by background and I knew how to program, I thought, well, why don't I get me one of these things? And I'm just going to program the ability to put the data in and pull it down from someplace and program the computer to do what I do every day. And then it'll generate a set of orders, and then maybe I could print them out and put them in the fax machine. And later on, figured out that there's these things called fax cards that I can, take the print and take it right to the fax machine and out to the order desk. And little by little, I kept eliminating my jobs. And I developed this philosophy of a human being can do something every day. There's two forms of human endeavor, so to speak. There's the artistic, creative side, which I think everybody loves to do, the artsy side, the inventive side. And then there's a lot of things we do as human beings that are just stuff that a machine can do. And it's just very repetitive and doesn't require any unbelievable brain behind it, in that if you can put down in a rule-based way exactly how you're doing what you're doing, then you can have a machine do the same rules. You just have to program it into the machine. And so what I try to do at Trendstat is keep everybody as much as possible working on the creative and inventing side of things, and let our computers free us of the drudgery of every day. That was the philosophy.
Okay, sure. No, that's excellent. So, I mean, kind of, you've talked about your systematic approach, but your actual trading method was, from what I believe, was very much based on a trend following kind of strategy.
Yes.
So, I mean, what was it about the trend following approach that you adapted that just meshed with your personality so well? Like, what are some of the key benefits to this approach that you saw?
Well, one of them was that a lot of the major mutual funds and brokerage firms constantly kept saying it can't possibly work. And yet I'd seen people of notoriety that had successfully traded along those lines. In addition, it was mathematical. In addition to that, it fit me because it was more long-term in nature, as opposed to trying to worry about what happened the last hour in the market. And I was a busy guy. I didn't have the time to mess with what happened in the last hour. I was, in the early stages, I was still working as an engineer, trying to do stuff on a part-time basis, trying to get an MBA, trying to build a house out in the woods that I custom designed myself. And there was a lot on my plate in my 20s and 30s. And I just really felt like I had to try to be very efficient about that. And trend following was a way of making sure that I always captured every major trend. And as I told you before, previously, in some years, as little as 2 or 3 trades would be the difference at Trendstat between making money that year and breaking even. So you had to capture every one of those big ones, and trend following would always mathematically capture a very large move. It couldn't fail to do that. And that gave me that reassurance that that's what I was going for. All this other stuff that you do every day, little losses, the 2/3 of the time that you lose money, that's all a lot of work to get you nowhere.
Yeah, and I mean, while we're on the topic of trends, do you find that the structure of trends has changed from, say, I don't know, 10, 20 years ago to how they are now? Like, is it fair to say that trends might have been much cleaner cut back then, and in today's market, the trends tend to jump around a lot more?
It could be. I frankly haven't taken the time to try to do that kind of analysis in the recent years, and I have been retired 12 years, so I would say that, yeah, there's some choppiness out there, and a lot of it could be driven by shorter-term computer action. But the way I like to think of the trading world that I have sort of observed over the last 3 decades, probably, almost 4 decades now, I guess, I think that the use of computers has sped up everything. So in the days when, that's lightning and thunder out our window here, in case you hear it in the background.
All right, yeah.
A little monsoon action in Arizona today.
All right.
I think the whole world in trading can now move, say, a few billion shares where they used to back when I came out of college in '74. A really good day at the end of the 73-74 bear market, which lasted 2 years, was 10 million shares on the New York Stock Exchange. To put that in perspective, SPYs trade hundreds of millions of shares all by itself. One instrument trades literally 20, 30, 40 times the amount that the entire New York Stock Exchange traded in '74, because they were doing it all by hand. There was tickets, there was telephone calls, there was, a lot of running around and very inefficient approaches to doing everything. So now you can do all that a lot faster, and you can even tell your computer to make the decision faster, to transmit it faster. Everything's sped up. So the way I like to look at it is, I don't know that the trends have changed all that much, but they probably happen a lot faster. So to me, what constitutes a full trend? It's kind of like a large cycle of human psychology when it comes to investing. There's the I don't want to ever get into the stock market again stage. Then there's the stage where stocks start going up, but I don't trust it. And then they go up a little further, and I don't know, maybe I should get into this. And then you start hearing about it at cocktail parties, and you almost have to buy it at that point. And by the time you get around to doing it, it's actually at the high and about ready to reverse that psychology and go the other way. Well, now a lot of that psychological shift from depression to euphoria seems to happen a lot quicker. We have telecommunications, we have, blogs and all sorts of news coming to our phones. So we know what's the latest on the Greek crisis and what is the prime minister going to say. And there's 25 people analyzing what he's going to say or what he's not going to say. And it's compressing. In the old days, you had to wait till the Wall Street Journal showed up to get some of this stuff. Nowadays, everything's electronic. Everything can react quickly. So I don't know that trends aren't there as much as the speed of those trends and the psychological changes that go through the market happen a lot faster, I think, than they used to in the old days.
Okay, sure. That's really well said, Tom. When we were initially speaking by email, you'd observed that there is an obsession, or seems to be an obsession, with predicting rather than being in the now amongst many traders today. Would you like to expand on this? I mean, I feel like you've got some interesting insights to share on this topic.
Well, yeah. To me, I get asked a lot, even at friends, parties, whatever, that people find out I used to be a trader, and we start talking about investing. It's something that affects almost everybody. And you'll get on conversations about, well, what do you think is going to happen to the dollar? What do you think is going to happen here? What do you think the government is going to do here? And I can carry on an intelligent conversation on economics. I used to have to pretty much know what countries were doing with their currencies, and I'd be fairly well read on that, if for no other reason than during a client interview where some major bank is trying to hire me to manage their currencies, that I can speak intelligently about various economies and at least appear, even though it has nothing to do whatsoever with my trading, to be intelligent and knowledgeable about various economic things that are going around the world. And I've continued to do that. I followed this whole Euro thing and the Greece thing with fascination, because in 1997, when people were interviewing me, I absolutely 100%, with no punches pulled at all, said that the euro is a dumb idea and it will never last long term. It cannot. You can't base all sorts of different political systems into a single currency that's based on a whole bunch of different balance sheets. It won't happen. Somebody's going to cheat. Somebody's not going to pull, their weight. Other people are going to be getting the shaft on it and having to pay for the people who aren't doing it right. And that's what you're seeing now. Germany, some of the German people got to be getting fed up with the attitude of places like Greece and Italy and Portugal, Spain, and other places that seem to be, socialist and debt-ridden and don't seem to be able to get their act together at all, financially speaking. And how long are you going to run that until you just say, I've had enough? And then you break it apart again. So I've always thought it was a dumb idea. Well, the prediction of that is all good and fine, but in reality, to trade, all I care about in trading is what should my portfolio be positioned this moment right now, period. Nothing more than that. You don't know what tomorrow's going to bring. You don't care a whole lot about what yesterday brought because that's already gone and never coming back. You really need to concentrate on looking at your portfolio. And I've heard Paul Tudor Jones say this on occasion, where he likes to start each day assuming that all his positions are wrong. Like he's starting all over again, and he's reanalyzing where does he want to be right now. And if he assumes that everything's wrong, he's critical then about every position. He tries to decide, no, I do like that position. I want to hold it on again for another day. I think that's trying to force himself to be in the now, and that's a good thing. It's the only thing you have the control as a trader of doing is buying or selling right now. You can't buy it 3 weeks from now. That's not going to, there's no point to that.
Yeah, that's a really good point. I'm glad you brought that up, Tom. That's excellent. So something else I've heard you talking about in sort of past interviews, maybe this was on Michael Coville's podcast, but you were talking about a coin flip concept. And what you were referring to was sort of how entries are less important than sort of money management and good risk management and exits.
Yeah, I did the random study. I just took the computers and I had them create a random number generator. And at the end of every day, if I didn't have a position in any one of, like, I forget how many markets, I think I did 8 markets. Somebody else in Austria replicated it with 20 markets. It came out the same. In fact, they might have even made more money than I did. But we were all slightly positive, not robustly positive, just slightly. But what it came down to is the same concept I mentioned already. If you trade all year long, and 2 or 3 trades are the difference between making a very nice profit versus breaking even, then you must be in on those trades someplace. And then once you get in on those trades, you need to let them run and mature and bring you those very large profits that you seek. A random number generator that just simply says, okay, I don't care which way I go. Markets could go down a lot, they could go up a lot. I'm just going to flip a coin. Whatever it says, the next morning I'm going to buy the open or sell the open, as the case may be. But once I get that new position, I have to try to assume it's the next really, really big winner that I've got. So I need to trail my stops at a logical level, give it enough room to move, to be safely restricting the risk, but at the same time giving it room for normal movement. So things like average true range, things like breakouts on charts, all of those types of things, depending on how sophisticated you want to be about it, could come into play to give the market normal movement, but to allow that profit to keep building and building and building over the long run for that one trade. As soon as it hits that stop, that tells you, well, that trend was not the one you were looking for that major, that major trade that would pay its way, pay the way for the portfolio to be successful for you. So what you'd end up with is you'd be out of the market and flip it again. Well, random number is going to give you 50% of them are going to be buys and 50% are going to be sells. it isn't going to be long until you're going to match up with that trend. When you are on that big trend, that's going to make all the money for you. And that's how you're going to make the slight amounts of profit for the year. You're going to have lots of losers, you're going to have some gainers, and you're going to have one or two or three very, very large gainers. And those are the ones you have to be in on, and a random number generator will give you those.
Okay, sure. So I'd like to move it along a little bit now and sort of touch on the subject of psychology. And I think I could almost quote you saying from other interviews that psychology is probably the most important aspect of profitable trading. So why do you believe this to be the most important aspect?
All right, well, I would say good trading falls into three different things that have to happen. The first one, which everybody spends all their time on, is the buy-sell decision. You have to have a way to say, this is how I would buy or sell a market, a stock, or whatever it is that you're trading. Secondly, you'll have to answer the question of how much should I buy and what types of instruments should I buy. I call that whole area the sort of portfolio management, risk management, volatility management area. And you have to be successful at that too. The third area, and the most important one in my opinion, and the one that a lot of people spend the least amount of time thinking about, is your own psychology. Because you as the human being who ultimately, even in the case of fully automated TrendStat back in the day, I had the power as the owner of TrendStat to go in and pull the plug on the computer or override it or do whatever, because I owned the company 100%. So if my psychology wasn't in good shape, and my knowledge of what we were doing comfortable with what we had created, then the first time I go through a drawdown, I'm going to start second guessing myself and all those computers, and I'm going to start telling my computer staff, oh, we need a whole new way of doing things, and let's go research this latest hot strategy that seems to have made 50% last year. And I could go buy black boxes or build black boxes, what's the difference? And keep switching and trading and fail time after time after time because my psychology wasn't right. So even though I was automated, you still have to have a good, balanced mind about what you're doing. Trading, like for instance, a good example that I've heard Dr. Van Tharp talk about, good trading is following your strategy that day. It is not whether you made money or lost money that day. It's simply following your strategy. And that's a very profound thing. Hit me a long, long time ago when I heard him say that. I thought, yeah, that's perfect. That's exactly what I do every day. And that's why he and I worked together a few years at least. I helped him out with some seminars he was doing, and I found it fascinating to meet a lot of people around the world, and we had a good time doing them until my schedule got so busy it got unreasonable to do them anymore. But that was a very succinct and smart way of putting it. Good trading is following your strategy. It's not, good trading isn't making money and bad trading losing money. Good strategy development is what you need to do. Once you have that strategy, you need to follow it and to actually execute it. And the time to change your strategy isn't at the heat of the moment, halfway through the trading session when your particular position is going against you by 3%, and you aren't sure whether you should pull the plug on it or not. You should have already figured that out, and it should be just blindly done. And when you're out of the position and the markets are closed, if you want to sit back and think about what just went on and try to come up with a better way, all good and fine. I'm not saying anybody shouldn't be constantly striving. I was sitting here, one of the reasons I called you a little bit late today was I got completely mesmerized by some stock research that I was doing. So I still am doing it here at 62 years old, retired. And I think you have to keep working and getting better, but you have to stick to whatever it is that you're coming up with unless you can figure out a better way. And I think a lot of people don't do that. I think they pull the plug on it, or they buy the black box, and 6 months later they throw it out and they change everything they're doing, and they're adding so many layers of filters. I've had people at Facebook give me a message and ask me questions, and I'll say, well, tell me what you're doing, and I'll see if I can react to it. And they'll go into this involved explanation of all the different filtering this, and they only do it if the ADX is that, and on and on and on and on. I'm wondering how they ever get a trade to happen. They get so many filters in the thing that they're trying to achieve perfection. And it's so complicated, it's probably not workable, and they're likely to miss those 2 or 3 very large trades that are going to pay the way. And because they filtered those trades out somehow. So I encourage people to really understand their own mind. I think some people are a little more cut out for trading than others. I think that sometimes extremely cerebral, highly intellectual, they view themselves as smarter than everybody else. They're brilliant. They sometimes have a hard time with trading because they just know too much. And some of the best traders, if you look at some of the floor traders, the people that have come off the streets that really didn't know a whole lot about investing at all, certainly don't have the MBA or anything, but they're successful traders because they find something that works and they stick to it, and they don't let the markets beat them up because they don't really have that mental side of them that wants to analyze and theoretically understand everything out there. They just want to make some money and go home, and so that's what they do. And so it's something to think about. Everybody needs to study their own psychology and try to ask themselves, what could they be doing to balance themselves out more so that when they're doing actual trading functions that they can stay in the now, they can analyze where they want to be fairly unemotional about it, and react quickly. That's really what good trading is, and that's psychology. And the first 2, you can do all the work you want, but if you don't have the psychology, you'll never execute those first 2.
Yeah, that's an excellent answer, Tom. Very, very well said. And when Jack Schwager interviewed you for the New Market Wizards, he actually dubbed you as Mr. Serenity because of your cool, calm, and collected style of trading. So, how were you able to actually achieve this and maintain this evenly keeled mindset, even through times of drawdown?
I've asked myself that question a number of times, and the only thing I can think of that seems to play in my mind about history and, my life looking back is that I was so darn busy doing so many things that didn't involve sitting by a phone or in front of a quote machine. And I had so many varied interests that were outside the markets. I've run into people that in the middle of the night wake up and they want to see a quote machine down by their bed and to know what the euro's doing tonight, or weird. That's obsessive to me. I like, if I'm going to cook dinner tonight. I like helping other traders. I yesterday was pruning my front yard. I love to do sort of an Italian landscape scheme with everything's flowering. I hand prune all my bushes and trees and do it myself. And there's so many things for me to fill up my day that trading just becomes sort of one of the many, many things. And by doing that, it sort of removes the attention to my conscious brain of all the different pre-crisis is doing this, and oh my God, gold's up $10, and all these different things that go on that could capture your mind and all of a sudden pull you down some kind of a psychological hole. Because I was so busy, because I allowed the computers to do their things, because I spent time programming those computers to do what I wanted them to do, and I knew they were doing that, it sort of gave me that peace of mind to, wonder what I was going to cook for dinner that night, or something else, or concentrate on my golf game, or have fun vacationing someplace. I didn't have to be obsessed with every day, read the paper, read the quote machines, look at the charts, agonize over everything. That's where I think a lot of traders, including Jack, I believe, back in the day when he interviewed me, he was very caffeinated. He New York, fast, go-go personality, constantly, driving, and a lot of the market wizards that he interviewed, some of which aren't around anymore, were pretty fast, high-risk guys in the end, and some of them blew up and didn't make it over the long run. By comparison, I was pretty boring, but where I was unusual was the kind of the systematic, keep it simple, don't get stressed out over it. And I think that appealed to Jack in a way because he sort of wanted to adapt some of that for himself. He was just the opposite, and I think that he found it appealing in a way. And that's probably how that chapter got written somehow. But it was a fun process. I enjoyed Jack, and he's a great guy.
Yeah, and just to elaborate on that, also during the interview with Jack, you spoke about viewing your life like a movie. So what did you mean by this, and how does this have a positive impact on your life, and probably more specifically, a positive impact on your trading?
If you watch a movie, you think about a movie that you've recently gone to see, the scene that is up on the screen right that moment is always going to be the now. So you are allowed to, guess where the plot's going. You might guess right, you might guess wrong. It's kind of like the markets. You might think it's going to go up more, but it might not. But you know what you're looking at right there, because it's on the screen right now. If you pay attention to right now, then you can enjoy and allow a horror flick to horrify you, or an emotional film to make you cry, or a comedy to make you laugh at that moment, because you paid attention and there was a joke there and you said, that's funny. Okay, so your emotions can go all over the place, but you aren't attaching yourself. You know it's a film. It's there for entertainment. You still have your own life, your own beliefs, your own everything inside you. So I like to think of the markets and life as sort of a movie. And you kind of know which way the movie's headed, sort of, but life throws you a lot of unexpected turns, so do the markets. And I think you just have to, kind of look at it and say, okay, that was interesting. Now, what are we going to do now? And how do you react to it? And what was your strategy supposed to do during that new information or new change in the conditions? And I think it keeps you a little bit separated emotionally from the actual trade, to look at it as a movie, than to feel like trading is your life and you're surrounded by it in every way you turn and look. The market, you wake up and you go to the market and you're checking the market before you go to sleep, and you got your phone in front of you all day long during lunch. You're not carrying on conversations with people because you're worried about what's happening with the euro. And that to me is not watching a movie. That would be kind of losing yourself in the middle of the movie.
Yeah, I like that concept. I found that part of the interview really interesting. So, I'm glad I sort of brought that up and got you to share that with the listeners. I think that's really interesting. So it seems like you've made a conscious effort throughout your years as a money manager, and even still to this day, during retirement, that your way of trading was designed to fit the lifestyle that you wanted to live, and not the other way around.
Yeah, I think a lot of people, again, Facebook and Twitter and all that, I must have like 1,000-something people that follow my Twitter stuff that I put out every now and again. It really started out as me trying to help out my stepson and my brother-in-law know which way I was putting my hedges on and taking them off, and it grew from there to all sorts of people signing up like it was a free service on which direction the market's taking lately or something. So, but I get a lot of calls and messages from people about how they view how do I trade? How does Tom Basso in his retirement trade? And I hate to be rude, but I feel like saying to him, why do you care? You should be designing what you do for you. Why would you want to I have a different net worth, I have a different expertise level, I have different computer equipment than you do. I may have different legal restrictions in terms of the markets I can trade. Some people live in India and they're asking me questions. I have no idea what the Indian stock market looks like. or what the regulations are, or what the brokerage conditions there are. Never ever traded an Indian stock, don't plan to lately, unless something changes. I just don't know anything about it. So why are you trying to apply what I'm doing to your life? It'd be better for you to be developing what it is that you want to do on your own. And that's exactly what I've done. I'm in retirement. I do spend a little time trading every day. Some days like today, as I just mentioned a while back, I got immersed in a little bit of stock research because I had some ideas I wanted to explore and think about. I didn't come to any profound conclusions, sadly, but it did certainly burn up a couple hours of my day. And nothing's changed. Tomorrow I'll do the same thing I did today in terms of trading, but it gives me some pause to think about it and all that. But I'm designing something that I can manage myself, that I can go on vacation and take my PC along and maybe spend 20 minutes to a half an hour a day. That's the most on a vacation I'm willing to part from the vacation. If I can get it all done in a short amount of time, I have an internet connection on a cruise ship, let's say, or wherever, I can get my job done every day, continue to trade my strategy, and it's designed around having me be able to do that. And I find so many people looking at systems and strategies that, man, they have full-time jobs, and I'm thinking, how are you going to do that with a full-time job? You're supposed to be out there talking to customers or building widgets, and how are you going to be able to focus and pull it off? You're going to miss trades. You don't have enough capital to diversify it. There's lots and lots of problems you see right out of the gate. The biggest thing I find with a lot of people is capital. They want to start from nothing, and they'll tell me they've got $2,000, and how do I start trading futures contracts? And I kind of scratch my head on that one because I have to admit I started with about a $2,000 or $3,000 account, had no clue what I was doing, and I'm sure glad that I figured it out because I ended up losing money for 4 years, and it took a long while to get to where break-even occurred. But as I got larger in size, more diversified, and got better risk control, volatility control, it all came together. I think trying to do all that with $2,000 is just mathematically impossible. So people are undercapitalized, they don't have a knowledge of what they're facing, and I think it's sad that they aren't thinking through what should they be doing to design something for them. If everybody listens to this broadcast and could just sit back and say, how could I make my own trading strategy my own? Make it exclusively mine, make it fit my lifestyle, my capital, my resources, my expertise levels. They're going to be so much more capable of hitting that psychological sweet spot of being able to stay in the now and do what they need to do because it's theirs. They don't have to worry about what Tom's doing with his stuff, or what Michael Covell's doing with his stuff, or Jack Schwager with his stuff. It doesn't make any difference. It's only important what I should be doing with my stuff. And I think that's what, if everybody could get that one thing out of this interview, I will have done great service to mankind.
Yeah, absolutely. No, 100% agree with that. And from listening to you in various other interviews, it's clear that you're a big believer in taking full responsibility for all aspects of your life. So I'd love to hear your thoughts on why you feel so strongly about this.
It's empowering, basically. Once I figured out that if I, through trading, was responsible for everything, including, I believe I told you earlier about the tip that I started my stock trading on, and it ended up being a lousy tip, and I had no idea what I was doing, and I blamed the guy that gave me the tip and blamed the company for not doing what it should be doing and everything else. But that's not empowering at all. You have to say to yourself, no, wait a second. I'm the one that called up, put the 100 shares on. I'm the one that's responsible. I'm responsible for figuring out what went wrong there and what would I do to make it better next time, and developing trading strategies. It's all on me. Nobody else is going to do it. Nobody else is responsible. The market is going to go through large ups, abrupt downs, It's going to have a lot of noise at times. It's going to be dull and boring at other times. That's what markets do. You can't blame the market for your problems. You got to take it on yourself and say, what can I do to deal with all of what mankind's going to throw at me over my lifetime? And when you answer that question, you'll be developing a pretty good trading strategy that'll suit you. And I think, sadly, around the world today, and Greece is in the news, there's a good example, Greece is not taking responsibility for their own mismanagement. So there's this tendency amongst a lot of various factions of society today to either blame somebody else or to expect somebody else to take care of some of their problems. There's less and less self-responsibility in society today. And I don't think that's leading us in the right direction at all. It seems to me that we're getting lots of governments around the world in trouble financially, more and more defaults. Argentina's not looking too good. Venezuela's a disaster. The United States is spending way beyond its means. We're just a little bigger and stronger, and so far so good. But, this whole thing starts caving in. I don't know how the world reacts to that. It's going to end up being pretty messy because there's a lot of governments around the world that are going to be in trouble financially. And when people just stop giving them money to, through government bonds and loans and things, or they deflate or inflate their currency by just printing too much of it, people are going to suffer in that country. And it's going to get nasty if people don't take responsibility and get the job done. So I think that's the whole thing about self-responsibility to me, is it gives you a little bit of that peace of mind, in that you have the ability to do something about it instead of having life kind of throw things at you and you kind of react to them and feel like life is throwing you hard turns and it's this guy's fault for not giving me that promotion. It's that guy or that woman who cut me off today that caused me to veer off the road or whatever. I mean, if you try to take responsibility for everything that happens, then you're going to be a little bit better at reacting and doing what's necessary to lead your life in a good way and make positive contributions to society, make positive contributions to your trading strategy. All of those things are going to be enhanced by self-responsibility.
Yeah, for sure. I mean, you touched on so many great points there, but Tom, we should probably start to wrap things up here, but let me ask you one more question. And you like to say, enjoy the ride. You often end tweets with this and these three words. And while they're very simple, I feel like there's a deeper message here. Would you mind sharing that with us? And what's the significance of this phrase?
Well, the significance of it is sort of a philosophical one. Life is like a ride, and you get your ups and downs and unexpected surprises and all that, and in the end, you're dead. So you might as well enjoy the ride. I think people make too much of some things. I know all sorts of traders that can't quit because they're so addicted to it. They identify themselves as traders. They don't identify themselves as human beings that are fathers and husbands and neighbors to other people. They instead are just immersed in this thing called trading. Or you could say the same thing about people who are teachers or people who are salesmen, people who install shades and blinds. There's all sorts of examples I can tell you about that I have friends that are well past normal retirement, but they just can't stop doing what they're doing because they identify with that. They haven't created an identity for themselves, outside of that. And the enjoy the ride thing is just basically to look at life like a movie, enjoy the ride. Just like most movies, there's unexpected twists and you laugh and you're emotional and you should be able to enjoy all that. Because life's short and why not do that? There's no point. There's no point to doing anything other than that, really. And I think the ups and downs of the market, when I usually get a signal change and all of a sudden people, I end it, enjoy the ride. it's like today we had the down signal come in at the time we're doing this interview. And it was just midday, and I saw the hedges go on, so I got on Twitter and I put it out to everybody, and I get 5 new people following me, and it gets shared all over the place. And it's kind of weird from my standpoint, but in reality, I had a down day today monetarily. I didn't go down as much as the market did, so that was good. I guess I buffered a little bit of risk. If the market continues down, I'll look really good. If the market turns around tomorrow and goes up, I'll look stupid again. And that's fine because I'm enjoying the ride. I'm going to go, work on a beautiful dinner for tonight, and I'm going to enjoy myself during the evening, and I'm not going to think about it a lot. Tomorrow I'll do the same thing again, and I'll continue to enjoy the ride.
That's excellent, Tom. Again, awesome advice. So, well, this has been nothing short of incredible, and like I mentioned earlier, it's a true honor to be speaking with you. So, again, thanks so much for coming on the podcast today, Tom.
Oh, my pleasure.
And before we let you go, do you want to share with listeners perhaps where they can connect with you on, and maybe your Twitter handle?
I'm at Basso, BASSO, _TOM.
Okay, good one. We'll make sure to put a link to that in the show notes at least.
The way to get a hold of me is actually on Facebook. Just put in Tom Basso, TOM and BASSO in Scottsdale, Arizona. There's only one of me.
All right, excellent. And we'll put a link to your Facebook profile as well, so people can connect with you on there. That'd be excellent.
Probably on Facebook because my new granddaughter gets a lot of photos on Facebook, it seems. I'm probably on there more often than I am on Twitter. Twitter is linked to, in that if I do a tweet, it automatically goes to my Facebook page, but it doesn't go the other way around.
Oh, right. Okay, it's all connected.
I tend to stay on Facebook more than I do. And the other thing you could always do if somebody has an involved question that's a little bit beyond normal messaging length, I've had people use the same old tom@trendstat.com, which is my old email address from back when I was still in the industry. I've kept the URL. It's still active. So TOM@TREND for trend following and STAT for statistics.com, Trendstat.
All right, excellent. Thanks a lot for sharing that, Tom. I'm sure some listeners will definitely have a few questions for you. So thanks a lot for offering that.
No worries.
All right. Well, again, Tom, thanks so much. Have a good evening, and let's talk to you soon.
All right, thanks, Aaron.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve risk and are not suitable for all investors. Traders. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up team? Welcome back to another episode of the Chat with Traders podcast, and you're listening to episode number 31. Now, this week I spoke with Luke Cummings. He's an Australian equities trader with 14 plus years of experience on his side. After making a last minute decision that journalism wasn't going to be a good fit for him, Luke went into a finance degree which led him to becoming a stockbroker, which then led him to becoming a trader. Nowadays, Luke remains an active trader, of course, and also operates a hedge fund based in Sydney. As well as this, he also runs a model portfolio service and trading blog, which goes by the name of The Long and Short of It. And we keep things fresh in this interview by discussing trading methods and strategies that haven't really been spoken about in previous episodes. Additionally, Luke shares some of the common traps that often catch entry-level traders and how you may be able to avoid the avoidable with some insight. For all the links and resources mentioned in this interview, all you need to do is go to chatwithtraders.com/31 and you'll be able to see all the show notes there. Alright guys, well I hope you enjoy this interview. I'm Aaron Fifield, your host of Chat with Traders, and here is this week's guest, Luke Cummings. Hey Luke, what's going on man? How's your day been?
Hi Aaron, very well, thank you. Day's going well. Looking forward to chatting.
No doubt. That's good to hear, man. Thanks a lot for making the time to come on the show. It's really good to have you here. And there's a number of things I'm keen to speak with you about today. Of course, we all want to know about your development as a trader, sort of from day one to where you are right now. And I'm also interested to get into some details about a strategy which you regularly trade, which is a takeover strategy. It's something we haven't really discussed on the podcast in the past, and it'll be good to hear more about this. But let's kick it off with your introduction to the markets. So where did this journey as a trader begin for you?
Sure. Look, to be honest, I guess I kind of stumbled into trading somewhat. I'd had no real exposure to the share market in my younger years. Grew up in country New South Wales, which is the state of Australia for your American listeners, and moved to Sydney when I finished school, started studying at night, working in the daytime. And one of the first jobs I had just happened to be working for an international fund manager, obviously buying and selling shares and currencies and whatnot as part of their portfolio management. It was very much an administrative-based role, so my job was to help settle trades and move cash and reconcile positions and so on and so forth. So no direct exposure to the market as such, but we're certainly aware of some of the things that were happening in the office at the time. My next step after that was I took a job actually at an online broker, E-Trade here in Australia. I don't think I was quite 18, or maybe I just turned 18 at that stage. So I finished school reasonably young. And I was just working in their customer service division at E-Trade, which was very interesting. It was April 2000. I actually started there about a week before the NASDAQ tech crash happened. Which was quite eye-opening at the time, but really was there with no preconceived ideas about the market. Had read some books and had some, I guess, exposure at university to the market. Anyone who's kind of got a finance degree, I guess, one of the first things you get taught is that the market is efficient, at least relatively efficient. And at that stage, I really had no reason to think otherwise or to believe otherwise. Of course, having exposure to people who are trading online and they're calling in and they're asking questions about the website and their positions and different things, to I guess sense their emotions through that period of the tech crash was very interesting, because they sort of say you can tell a lot about a person when they're under pressure, when money's involved, and that was certainly an eye-opening experience. But a colleague who I worked with there took a job at a broking firm probably about 3 years after we'd been working there. I got on pretty well with him socially. I wouldn't have said he was a great friend of mine, but we'd always gotten along well. And an opportunity came up to go and work at the firm that he was working at. Part of the pretense under which we were lured there was, all of these client accounts that they had that were dormant and needed servicing that weren't being serviced at the time. Seemed like a really good opportunity. And I guess the reality was when we got there that the number of clients or prospects that existed were less than we'd been led to believe. And we sort of figured out that, if we're going to rely only on broking commissions for our livelihood, that we probably wouldn't be doing too well. So we also had a bit of time on our hands because, we weren't as busy as we had been led to believe. So we just sort of started looking at the market and doing a little bit of trading ourselves. Obviously, we have exposure to clients who are doing something similar. And, to be quite honest, one of my business partners who's still my the colleague that I was talking about, who's now one of my business partners, just stumbled across this thing one day and sort of said, look, I think there's an angle here. And I was like, sounds great in theory, but, I've been to university and I've studied finance. I know that the market's efficient and, something that simple surely isn't going to work, or at least not consistently. There must be something we're missing. And, I wouldn't say we paper traded in the way that people, I guess, think about paper trading now, but we watched a couple of these situations evolve and, we're like, well, it looks like there's an angle here. And I guess we just sort of started to, systemically exploit that and to look for those types of situations. And it was actually a really profitable little niche that we'd found. And I guess, really that was the start of the process for me. I took that job without having any intention of being a trader. It just sort of evolved that way. And that was, I think, 2003 or 2004. And in one form or another, we've been at it ever since.
Okay, that's excellent. So I'm keen to sort of break that journey down a little bit more and touch on some of the points you mentioned. So just before I do that though, what was it about trading that actually appealed to you, or maybe not even trading, but just the markets in general? Because, when you're young, you have the opportunity to go pretty much any direction you like in terms of your career. What was it about the markets and trading that really got your attention?
Yeah, it's a good question. I actually intended to be a journalist initially, and that was very much my plan. Right up until the time I finished school, I was going to study journalism. And at the last moment, for whatever reason, I just decided that, I didn't think I wanted to be a journalist. And I really was just looking for a job, to be perfectly honest. I knew that I wouldn't have the luxury of going to university full time without working. And it just so happened that, one of the first roles that I stumbled across was the job, administrative job with the fund manager that I mentioned earlier. I think, once I got a little bit more exposure to the markets though, I just think it's a fascinating thing, and I'm not sure necessarily that I thought about it in those terms at the time, but, you have this thing that every single day there's something different, as in there's no, set pattern to how things evolve throughout the course of the day. You can be having a quiet day. Right now it's, 2:15 in the afternoon here in Sydney. Something might be about to happen in 5 minutes time that I couldn't foresee or wasn't expecting, that could be one of the best opportunities that we have of the year. I think I was really drawn to the fact also that you can make money that isn't directly correlated to your effort, in the sense that in my school holidays when I was still at school, I was doing some manual work like landscape gardening. My job was really to do the hard yakka, I guess, of the digging and the moving and the lifting and whatnot. And you come home at the end of every day and you're exhausted and you've earned, whatever, $15, $20 an hour. But you can only earn more money by working more, and it's hard work. And then you have, trading, which, of course, you need to put effort into that. And as time's evolved, we've developed systems and whatever else. But the idea that a little bit of effort can make you a little bit of money, or can make you a lot of money, and that you don't necessarily know in advance which it's going to be, was certainly appealing to me. I think all traders probably at some level, are driven by a desire to have a better life or a better lifestyle, to have money. I think somewhere along the way, the money becomes less important, actually, probably once you start to, consistently make it. But I think definitely for me, I didn't grow up in a wealthy household. No one in my house talked about stocks. I'm not even sure that I knew anyone who was trading or investing in stocks, at least not directly. So I think the idea that, you could build a better life for yourself and that it wasn't through manual labor as such was probably, at least at the time, what appealed to me.
Yeah, I really like that answer. And I think a lot of people listening, including myself, can, really relate to that. So you mentioned there that you were at university, and was it an economics degree?
It was a finance degree, which I guess had an economics component, a finance component, accounting component, so on and so forth.
Okay, so you mentioned that they sort of taught that the markets were efficient, but when you sort of started trading with your partner, like you mentioned there, you were sort of saying that the markets weren't efficient. What do you mean by efficient and inefficient sort of markets?
Sure. So I guess, if you sort of think about university and finance or economics, we have this concept of the efficient market hypothesis. And really, in a nutshell, what that tells you is that in its most purest form, everything that should impact the price of a security, so whether it be a stock or otherwise, at any point in time is priced into that security. So the idea is that, by knowing information about, the PE multiple or the company's earnings, or, by looking at the chart or whatever, that there shouldn't be any discernible ongoing advantage by knowing that information because it's already in the price. Now, in its purest form, they teach you at university that, it includes all known information and all unknown information, and that's, I think, called pure form efficient. And then they have this concept of semi-form efficient, which is that all public information is in the price, but information, inside information, I guess, is not in the price at that point in time. And I think sort of logically that makes sense. Certainly, if you've had no reason up until that point to think otherwise. At a fundamental level, to me at least, it sort of made sense. It's like, well, okay, if everyone knows that, the current earnings are this, or that this company's released a new product, or, that the economy is doing this, or whatever else, it makes sense that these things are priced efficiently. Now, I think as things evolve and as you learn, you realize that, that's an efficiency at a point in time is probably the argument that, that is making, or that concept is making. And of course, prices can move as new things develop. So, maybe an existing product's more successful than the company and the market had anticipated. Maybe it's less successful. Maybe, there's a currency impact for one of its earnings of one of its divisions. But I actually realized, very early on, or my partner and I realized that even that couldn't account for what we were seeing, because every day stocks are moving really with no discernible reason for them to move. So, you can make an argument that maybe information is evolving, or that someone who, has an incentive to buy or sell a security has learned something new that maybe they were previously not aware of. But I think that, in a lot of stocks, if they're liquid enough, that's probably not enough to account for the reason that you see some of these securities move in the range that they move on a daily basis. And I think, that combined with the fact that we'd sort of found this, little niche that we were exploiting quite profitably, it was really telling us that, well, the market's not efficient at all, at least certainly in some respects. So I think that, there are some instruments probably where you can make an argument that the market is reasonably efficient because there are so many people looking at them, and information about what drives prices is very readily available. But there's a bunch of stocks and I'm sure other instruments as well. And stocks, I guess, is our area of expertise that people just aren't looking at or paying attention to, or there are angles that they haven't thought of. And one thing for us, I guess, is that I've listened to some of your previous podcasts on the site, and I'm slowly working through the rest of them. But Tim Sykes was saying that you were talking to him about his edge and why he chooses small caps or penny stocks, and he sort of used the example of if you're going to play basketball, do you want to play against Michael Jordan, or I'm not sure it's politically correct, but do you want to play against a midget? And it's a funny analogy because I kind of agree with him in that I think there are areas of the market that are harder to compete in. I mean, if someone like Goldman Sachs is throwing all of their resources at an area that I'm trying to compete with them in, I think that's very difficult. I think, where we try to play a lot of the time is in areas that, Goldman Sachs probably isn't paying attention to because it's too small in terms of, what it can add to their bottom line, or it's an area that, these guys go to the same universities and colleges that I went to that teach you that certain things are efficient or can't exist or aren't possible. And I think that leads to them ignoring a lot of areas of the market that can actually be exploited. And I suspect that of all the people you're interviewing who are trading for a living, I mean, they all at some level believe that the market, and probably have proof that the market's not efficient, because if the market was efficient, you can't make your living trading, like they do and like I do. So that was a real eye-opener for me, I guess, is that, one of your other interviews, someone mentioned, stages of development, and one is, you're making money, but you can't figure out why. And then you're not making money, you can't figure out why, which is maybe worse. And then, you're not making money, you know why, and then you're making money and you know why. And I think that's the thing. Like, if you're making money and you really want to make a career out of trading, I think you really need to be able to put your finger on, pretty quickly, at least at the point where you're going to scale up in terms of the time and financial resources that you commit to it. You've got to understand why it is that you're making money and where that advantage is coming from, because randomness can account for a lot in the markets and in life, right? You do a trade that makes money, doesn't necessarily mean it was a good trade. You do a trade that loses money, it doesn't necessarily mean it's a bad trade. I think people confuse the end result of what they did with the intent that they had, or the reason for them taking the trade in the first place. And I think that was important to us early on, was to try and figure out, hey, are we just lucky here, or have we actually found an inefficiency in the market? And sitting where I sit now, and for some time, I definitely believe that the market isn't efficient, at least in some areas.
Okay, yeah, that's a really great answer. And thanks for really expanding on that too. So all in all, would you say your degree from university and your experience as a stockbroker, did you find that this had any benefit to you when it actually came to trading your own money?
Look, definitely. Maybe not for the reason that I would expect, though, or that listeners would expect. I mean, the university component, I think, was really great. One, for exposing me to things in terms of terminology and concepts and whatnot that I just wouldn't have had exposure to otherwise. But once you get past that, initial fundamental knowledge base, I think it's really great, looking at it in hindsight, to know or understand what everybody else in the market, at least who are finance professionals who are working as portfolio managers or prop traders or whatever they're doing at all these firms. I think it's great to understand what they're taught and why their belief systems are, what they are. So from a university perspective, I think that was really great. From a broking perspective, I mean, I think outside looking in, you think about a customer service role at an online broker. It actually sounds like a pretty terrible job. But I have to be honest, that the two business partners that I have, we all came through, E-Trade at similar times. We didn't necessarily work together, but we all had that grounding or that base coming through E-Trade. And the cool thing about that was that you're not getting paid very much, but you're going to work every single day and you're learning about the market. So you're learning about how the market actually physically operates and some of the rules and regulations that govern it, and some of the idiosyncrasies of the market in terms of the market itself. But then you also have the benefit of seeing human emotion in operation more or less in real time, because you're talking to these people over the phone who are having problems, or have questions about whatever, but you can't help but figure out I guess what their emotional headspace is, and you get some exposure to the types of trades and things that they're doing. So I actually can't imagine being in the position that we're in right now had we not had that education, in online broking, because it's basically like getting paid for 3 or 4 years to do an apprenticeship or an internship where you get to learn everything about the market. And I think, the alternative to that would have been trying to learn all of that stuff at night or on weekends or before work, or, in addition to having other jobs. I think would have been really difficult. moving on to when I became an actual broker and was giving advice to people and looking after accounts. Also very interesting, I think, the way people react to making profits, the way people react to making losses, the amount of opportunities you would call people with and say, hey, look, here's a really great trade. Here's the downside. Here's why I think you should do it. And, their reasons for not doing it or whatever, I think is very interesting. So, yeah, if I had my time again, I think the path that all three of us took to get to where we are now was really perfect. And the other cool thing was that, in the year 2000, online trading hadn't existed in this country for very long. It hadn't existed in any country for very long. A lot of the customers at E-Trade were still using dial-up internet and couldn't talk on the phone at the same time they're using their internet. And it was sort of just, a crazy time. And it was kind of nice because it's not like coming into an industry where there are people with 30 or 40 years worth of experience that you don't have. At most, there's probably people with a couple of extra years experience trading online than what, I had at that time. So I think timing was beneficial in that regard.
Yeah, right. That's really interesting. You kind of mentioned a little bit earlier, you talked about once you did start trading, you and the partner who you were trading with came across sort of a niche or a little area, a type of trade or strategy that you could exploit, and you were making decent money from this strategy you discovered. Can you talk to us a little bit about maybe how you discovered that strategy, and are you still running with that strategy today?
Yeah, sure. Look, this credit for finding the strategy definitely goes to my partner at the time. I've actually never really discussed it with him in detail. I presume he just sort of stumbled across it by accident. We sort of found a way to exploit a loophole around capital raising in typically smaller cap stocks. To get access to discounted securities. That some of these companies were offering. Of course, depending on the company, sometimes no discount, frankly, is big enough to want to give them money. Other times, the opportunities are attractive. So, sadly, the loophole we were exploiting no longer exists. The rules were changed such that the way we were obtaining access to them at the time no longer exists, which is a shame. But we basically went through the process of doing this ourselves. And because we were somewhat capital constrained at the time, there were really two forms of leverage for us. One was to share those opportunities with our clients, which we certainly endeavored to do as much as we possibly could, and had a lot of clients who made a lot of money from that at the time. And the second way was for us to get our hands on more capital ourselves. And I mentioned to you when we were chatting earlier that the way that we did that at the time, which I definitely do not advocate to anyone under any circumstances, is we actually use credit cards because we're young guys. Like I was only probably 20 or 21 at that stage. I didn't have any money. I probably still had a little bit of consumer debt from university and buying a car and all these things that you sort of do. So we sometimes are making 5, 10, 15% a month from some of these trades pretty consistently. So even if you're having to pay a bank 15, 16% a year in interest, which sort of sounds crazy saying it now, but it was a smart thing for us to do. And we'll probably get to this later on in terms of how our trading strategy has evolved through time. But one thing that, or a couple of things about that was, one, we needed to be pretty damn sure that we could make money consistently, given that we were using someone else's money. But it also made us, I think, very mindful of risk, and sometimes that it's just better to take the fat, easy part of profit out of a trade without a lot of risk, rather than really going for the entire amount of profit that might be in the trade. So I think if you use a baseball analogy, sometimes a base hit or a double is better than a home run if you could get that base hit or the double more frequently than you would get the home run. So that was what we did. But I actually think, and I don't have proof of this, but I think the strategy we were running and the extent to which we scaled it amongst our clients, and it sort of became a reasonably well-known strategy, certainly at least within a niche in the Australian market, probably was what at least partially contributed to the subsequent rule change about that. So it was a cool little thing. And one thing we don't really know now is whether or not maybe we should have kept it a little quieter and we'd still be trading it now, because it just wouldn't have become such a prominent thing. But onwards and upwards, no regrets. But it was a cool thing. If we hadn't found that, I don't think that we'd be doing what we're doing today, and we wouldn't be talking about this. So that was pretty cool. And I guess the interesting thing is that sort of a long way to answer your question, but you sort of think about how people become traders and the preparation they do, and maybe they go to a course. I've listened to your own interview about starting out with GAN and going to a seminar and learning about that. And some people read books and learn about fundamentals, and you've spoken to people on this podcast who are crazy into programming and backtesting and different things. It sort of seemed a bit surreal that we kind of just stumbled across this thing that no one was really talking about, and it wasn't particularly sophisticated, and it was just really easy to exploit it for profit at the time. That was sort of weird, because even things like having a trading plan and things, I mean, all those things come after, but all of the things that you think that you should do and that you need to know in advance to start making money in the market, we weren't doing any of those things. And some of our friends and colleagues who were working at other firms and things like big name financial firms sort of knew what we're doing. They're like, you guys are crazy. Like, what are you wasting your time on all these small ridiculous trades for? Like, what's the point? I felt, and I think probably my business partner at the time probably felt a little bit of an inferiority complex, where it's like, we're not really serious, as in no one's taking us serious. This is kind of a small strategy that is a bit of a niche, and it was almost embarrassing to talk to people about it. But it just became such a big thing, and we made so much money from it. And it's funny now, looking back on that, and some of the people who at the time were like, you guys don't know what you're doing, you're just lucky, and loophole's going to close and that'll be it, you guys will have to get other jobs and things. Some of those people now are like, okay, what else have you guys got? Like, tell me some other strategies, what should I be buying, or whatever. And I think that's been an interesting process to go through. I wish I could say that we set out with intent to become professional traders and did all these cool things, and that we're super smart and great at math and all these things, but it just, for us at least, hasn't really worked out that way. And I think if I look back, the fact that we weren't doing what everyone else was doing, and that you couldn't just turn up somewhere and learn what we were trading in a course or read it in a book, it's actually probably what made it work in some ways, because we just kind of found something that no one else was looking at the time.
Right. Okay. So right at the start of that, you mentioned you were sort of purchasing discount securities. What do you mean by discount? Just so we understand before we move on.
Sure. So looking in a purest example, which is not the strategy we were using at the time, but in Australia, Westpac Bank owns a fund manager called BT, or partially owns a fund manager called BT. American listeners can look it up online briefly if they want to, but we did an offer recently where they sold down part of their holding. Westpac sold down part of their holding in BT, and the reason they did that was because in Australia they're talking about changing some rules around the level of capital that banks have to hold, and the penalty from a capital perspective of them continuing to hold BT, I guess in the bank's view, was greater than the benefit of continuing to have the shareholding in BT that they did. So, very basic level, Westpac says anyone who's an existing BT shareholder or who is an existing Westpac shareholder will have the ability to buy BT shares at a fixed price of $8.20. Now, this is for existing shareholders only. So if you don't hold shares in BT, or you don't hold shares in Westpac, and that announcement is made, then there's no way for you to participate. Many years ago, if you didn't already own those shares, sometimes they would say anyone who's a shareholder in a week or two's time, or 3 weeks' time, whatever it's going to be, will be entitled to participate in that offer. So in the case of BT, which is sort of underway at the moment, BT announced, or Westpac announced, they were doing that sale when the share price was $8.20 about 2.5 weeks ago. Of course, we've had a lot of market volatility in that time, but the last week or so, the market's rallied pretty hard. BT shares as of yesterday were almost at $10. Today they're, I think about $9.50 or something. It's quite a big price gap there, right? So, if you have the ability to buy BT shares at $8.20 and they're currently trading at $9.50, it doesn't really matter what you think the outlook is for BT. You don't need to want to own BT for any great period of time. You're basically being offered something that's worth $9.50 today for $8.20. As long as you think that between now when you buy BT and when you're able to sell them, when your new shares are allocated, that's sort of a no-brainer transaction, right? Like, it's like me saying to you, give me $8 and I'll give you 10. It's like, well, what's the catch? That seems a bit too good to be true. But it exists, and the thing is now there's no exploitable angle because that window is closed by the time that's announced. But previously, that window wasn't closed, and that was something that we took advantage of as much as we could when the rules existed in that format. So what we're basically trying to do is figure out, how do we buy $10 for $8, or how do we buy $5 for $4, or whatever the case may be.
Okay, sure, yeah, that makes perfect sense.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
Let's fast forward to current times now and talk about how you're trading these days. So give us an overview of your approach to the markets that you apply, in current times today.
Sure. So I think at a fundamental level, the premise hasn't changed for us in that we're not trading the same strategy that we were back then. But one great thing about that strategy was that the reward on offer was outsized relative to the risk that we were taking. So I think you're always taught, and we talked about that, my university degree earlier, the idea is that to get more reward, in theory, you have to take on more risk. And I think fundamentally that's pretty well accepted. What we're really looking for are situations where we think that the reward on offer exceeds the level of risk involved in us taking that transaction. And that maybe sounds a little strange or a little crazy, but the idea is the same as that loophole we found before. There are other things in the market that where that exists, I think, and we really have a couple of different components to our business now. So the original business partner or colleague at the time that I mentioned, they started working with more than 10 years ago, is still one of my business partners today. I have a second business partner as well who joined along the way. And the two of them primarily are focused on really short-term stuff. So non-client facing stuff, typically day trading. We try and be pretty flat at the end of every day. And it's time intensive. They're every day, at least while the market's open, sitting glued to their screens, looking for opportunities and trading. So there's that element of our business, and I'm not really actively involved in that these days, just because it's so time intensive, and in order to do some other things within the business, it's difficult to do that if you're glued to a screen all day. So that's one part of what we're doing. The second part is we have a managed fund or a hedge fund which trades longer term type strategy. So day trading isn't really appropriate for that vehicle. So our takeover strategy, which you mentioned earlier, fits within the fund, plus some other kind of longer term scalable type strategies. And I guess the more recent development there is the blog that we've started to share some of our ideas, some of our more simple ideas in the takeover space that retail investors are capable of implementing themselves without it having to be through our fund or needing any special help to do. But the one thing that drives all of those areas or all those business divisions is this idea of risk reward. So what we're really trying to do in the first instance is make sure that we really strongly understand the downside in each situation. And I guess upside is secondary to that. I think one mistake that a lot of people make when it comes to trading is they're really thinking about, what's my potential reward here? How much money can I make? And their position sizes are really dictated by, what they're imagining their profits are going to be if things go in their favor. We're the complete opposite of that. We're really trying to figure out, okay, we're happy to risk X amount per trade, for a stock standard, what I'll call opportunity. And that really dictates our position size. And I guess we'll cover the takeover thing in a little bit more detail shortly. But some of the opportunities in that space are more interesting from a risk reward perspective than your standard opportunity. So we have some discretion to vary our position size accordingly in that situation. I think if you're pigeonholing what we're doing, it's I call it rules-based discretionary trading. So we have a fairly fixed framework around what we're looking for in all situations, and lots of alerts and triggers and things that alert us to opportunities. But all of it has human intervention. So it's always someone looking at that saying, is that opportunity as good as it appears to be? Yes, it is, let's take it. Or alternatively, no, it's not for X, Y, and Z reason, and therefore we're not taking it. And look, probably the best example I can give of a trade where I think that the reward is outsized relative to the risk. It's one we did recently for our fund and through our newsletter, or through our blog. And that was in a stock called Panos. Australia PNA was the ASX code. And the history of Panos, very briefly, was that they had a copper mine or several copper mines. Major shareholder was a Chinese company, had made a couple of approaches to Panos previously about taking them over at higher prices than where the takeover subsequently happened. At the time, Panos board said, no, we're not interested. The price isn't high enough. We really went through that period of 6 months or so of commodity price corrections. And the major shareholder, Chinese shareholder, comes back and says, we're making another takeover offer. Takeover offers can vary quite considerably in terms of how they're structured. But the cool thing about this most recent offer for Panos was that the price at which the takeover was being made was guaranteed. So it's basically called an unconditional takeover. And I think $1.71 from memory was the takeover price. We trade so many of these, I can't remember exactly, but let's call it $1.71 for argument's sake. As soon as that takeover is announced, Panos is trading at $1.72. So you can basically buy Panos as much as you like, more or less, for a number of days at $1.72 or thereabouts. knowing fine well that no matter what happens, so if there's no improved bid, even if the market tanks during that time, you're going to be able to sell that stock at $1.71. So that's really your hard stop loss that you've got in place, at least for the period that the bid exists. But it wasn't a crazy thought to think that Panos might get an improved bid, maybe not a competing bid from a different shareholder or a different company, given the reasonable shareholding that the Chinese company already had. But the bid that they'd pitched most recently was about 20 or 30% below where the bid had been pitched previously. So it wasn't ridiculous to think that the bid could be improved by 10 or 15% above its current level. In order to get board acceptance and get shareholder acceptance. So, the way that looks is that if the takeover price is $1.71 and it gets a 10% bump, the new price becomes $1.88. If you look at that, what you were risking in that situation, you're really only risking that 1 cent per share because you can get that $1.71, yet you have the potential to get $1.85 or 88 or more, potentially $2. So for us, I love that trade because I know exactly at the outset what my downside is. I've got that locked in. I can position size accordingly. And if the trade works out, then the multiple of reward relative to risk that you get is very, very great. The headline percentage, it might only be a 10% return on the capital invested. But if you look at your return on risk, if you get a bump in the share price or in the offer price, it's almost unheard of. So that's not to say that Panos was definitely going to get that better offer. It's very possible that the Chinese company just says, look, that's our best and final offer, too bad, and we lose a cent a share. But at the outset, that's a nice trade for us to take. And as it turned out, they got a bump of almost 10%. I think $1.85 ended up being the price that it was taken out on. So we made 8 or 9% headline return on the trade, but had a very big position size because we had that downside built in, and we really got about 14 or 15 times what we'd risked as a return on the trade. So that, in a nutshell, is probably the best example I can give you of what our holy grail trade looks like.
Okay, yeah, that's really interesting. So, I mean, you obviously sort of talked a lot about an example there of sort of the takeover strategy, but if we could just sort of take it back to step one. What's the general objective of this type of strategy? So let's focus in on your actual takeover strategy. What's the general objective of this?
Look, so the general objective really is, which applies across our whole business, is to try and take lowish risk trades with good payoffs. The great thing about the takeover strategy specifically, from our perspective, but also from our investors' perspective, is that takeovers have generally pretty low correlation to the market. So once a stock is under takeover, depending on the level of conditions attached to whether the offer is likely to proceed, more often than not, it's no longer trading in line with the broader market. So you don't need to worry about having a position that you wake up tomorrow morning and the Dow is down 5%. Your takeover positions just aren't going to get sold off, or if they do, they shouldn't be, and it corrects itself pretty quickly. So it's a really low volatility strategy for us in terms of it has low market beta. And that's part of the reason that we actually decided to put it in a fund, and that we've rolled it out through the blog because I think there are a lot of people out there, certainly in Australia this is evident, maybe less so in the US, but I presume it's a similar issue. Lots of investors who have had share market risk previously or have it now, and they really don't want the volatility that goes with that. The share market's great in terms of being a trader or being an investor, holding managed funds, whatever, when it's going up. But people don't want those massive drawdowns that you get in the GFC, in an extreme example, even the hit that our market took, and that I guess a lot of global markets took last week when we had the dual issues of China's market falling over, and also these issues in Greece. I think people don't like that. As much as in advance they may think that their risk profile is that they're happy to take some risk in order to get the upside. I don't really think that fundamentally that's the case. But at the moment, these people don't really have the choice to not be in the share market because the returns on deposits in bank accounts are so low at the moment that especially if you're a retiree or you're getting towards retirement and you need that income to live. It's just not on offer. So